Hello people, welcome back. So let's quickly start revising our IND AS 115 revenue with contract with customers with the help of our chart book. So how should we recognize the revenue is what this particular standard gives us the guidance on. Okay. So first, there are about 5 steps which we need to follow for revenue recognition. Okay. One is identifying the contract, identifying performance obligation, finding out the transaction price, allocate the transaction price to the performance obligation, recognize the revenue when performance obligations are satisfied. So these are the 5 steps which we need to follow, which we will study one by one. Okay. So first step is identifying the contract. So a contract means it's an agreement between 2 or more parties that creates enforceable rights and obligation. Because of contract, the rights and obligation of the party should be established. That's when we call it as, or that's what we call it as contract. And when do you say that rights and obligation get satisfied? Provided certain features are there, which we used to call in our class as ArP&x. Yes, A means the contract term should be agreed by all the parties. R for the rights of all the parties you should know. And P for the payment term should be identified. How much to pay, when to pay, in what mode to pay, all that should be able to identify. And C, the contract should have commercial substance. And last, the consideration collection should be probable. Commercial substance means we already studied in AS 10. So due to this particular contract, the cash flow, the risk, timing, and the amount of cash flow should change. If one person purchases the goods for 8,000 and sells it for 10,000, obviously he paid 8,000 to purchase and he's receiving 10,000 on account of sale. So cash flow is obviously changing. So because of this transaction, the cash flow should change. The risk, timing, and the amount associated with cash flow should change. That's what we mean by commercial substance. And the consideration collection should be probable. Meaning after selling, you should have a reasonable assurance that we will collect the money. It's not that immediately you should collect the money. If you have a reasonable assurance that we will collect the money from him or that particular the debtor in future, that's good enough. Okay. So this is the contract of features. Then, sir, if you have multiple contracts, can we combine? If you have entered into multiple contracts, yes, if you can combine, provided it is entered with the same customer and nearly with the same time. If multiple contracts can be combined, provided it is entered with the same customer and nearly at the same time, and one of the following features. One, it is negotiated as a package, and 2, price dependency. Let's say negotiated as a package means, let's say you have a contract to sell product A and product B. A and B put together, you have negotiated for 1 lakh. You have not negotiated the price separately. You said A and B put together, it is 1 lakh. So this is your package negotiation. Or price dependency on each other. You told A, we will sell it at 50,000. Because you are ready to buy A from me, we told we will sell product B for 30,000. Like that. Normally we sell product B for a higher amount. Because you are purchasing product A from us, we will sell product B also to you at lower cost. Like this. So the price of one product is dependent on price of the other. If this price dependency is there, means you can club. Or it's a single performance obligation. More about performance obligation we'll see a little later. So or it represents single performance obligation. So if these are there, then you can combine the contracts. All right. Next thing is contract modification. If you have changed the terms of the contract, meaning the change in the scope, price, or something, contract price or contract scope, if it is changed, we say contract modification. Now, contract modification could lead to a separate contract or not a separate contract. Same like lease modification we learned here also. So you could treat this contract modification as a separate contract, same features. If you want to treat it as a separate contract, one, new goods or service should have come in, and increase in the contract price should be commensurate. It should be at par with standalone selling price, meaning it should be done at market terms. Same lease condition, lease modification, we learned separate contract, no? Not only over here. So if new goods or services come in, obviously if new goods if you have come in means obviously we charge extra price. So the contract price would have increased. So the increase in the contract price should be as per the market terms. Only then it will lead to a separate contract. Otherwise, if it is not a separate contract, we do something called cumulative catch-up accounting. So let's learn this probably with the help of an example. Let's look at our case study. Question number 3, let's look at. An entity promises to sell 120 products to customer for 1,20,000. Okay, 1,000 per product. The products are transferred to the customer over a 6 months period. The entity transfers control of each project. 1 minute. Okay, it's okay. I think we can look at this. The entity transfers control of each product at a point in time. After the entity has transferred control over 60 products. 60 products is already transferred, but the deal is to transfer 120 products. Okay. After the control has been transferred for 60 products, the contract is modified. You did some modification to require the delivery of additional 30 products. So initially, the totally are to deliver 120 products or sell 120 products. Later on, after a few weeks or few months, you have modified the contract saying you have to deliver additional 30 products. Okay. And at the price of this is 950. Original price was 1,000 per product. Here it is 950 per product for this additional product, which is a standalone selling price for such additional product at the time of placing the order. Okay. So now they are saying, what is this? What is the nature of this modification? Sir, is this modification a separate contract? Very much yes. Why? Sir, new goods or service, if you want to call it a separate contract, new goods or service should have come in. Here new goods has come. Yes, 30 new products have come. So this condition is satisfied. And the price of this new 30 goods should be at market terms. Is it at market terms? Yeah, this 30 product you're selling it at 915. What are they saying? Which is the standalone selling price of such additional project at the time of placing the additional product. That means market price of this product is also 950 and we are selling it at 950. So that means the increase in the contract price reflects the standalone selling price of the additional products or service. That means both the condition is satisfied. That means this will be accounted as a separate contract. Old contract accounting will happen normally. New contract accounting you do. I mean this particular 30 products accounting you do it as separate contract. Meaning for revenue recognition there are 5 steps. No, for old contract you do the 5 steps separately. For new this you treat it as separate contract and you apply 5 steps separately. That all are done. Okay. So let's look at maybe one more question. Question number 5. Growth Limited enters into an arrangement with the customer for infrastructure outsourcing deal. Okay. Some infrastructure, maybe some building or something. We're doing some customization maybe. Based on the experience, Growth determines that the customizing the infrastructure will take approximately 200 hours. Okay, we are doing some building renovation probably. So we are billing in hours. We thought it will take about 200 hours. Okay, the promise is to, or the obligation is to do the infrastructure service. Keep that in mind. So to do that, we need 200 hours and we are billing it at 150 per hour. So 200 hours we need and we charge the customer 150 per hour. So how much is this? 200 into 150 is about 30,000 rupees. Okay. After incurring 100 hours of time. So 100 hours is already over. That means we have already recognized the revenue. How much revenue recognized, sir? 100 hours is already over and per hour we are booking 150 means 15,000 revenue we have already recognized. 100 ka 150 per hour. Okay. Growth Limited and customer. After 100 hours, the Growth Limited, the entity and customer agreed to change the aspect of the project. Change the aspect is modification. Contract modification you have done. And increases the estimated labor hours by 50 per hour. The labor hours increased. Sir, that means new product has come in. No, sir. What is the overall contract objective? To give infrastructure service. That is the main thing. So is the new infrastructure service has come to you? No, it's the same thing. Maybe when you're doing the work, customer asks for extra customization, some vastu problem. Normally in the construction, this happens, no, right? So initially you will go out with one plan. After that, you will slightly change the plan. The customer will say, don't put this marble, put that granite. Okay. Don't put the room in the east side, put it on the west side. Puja room, you put it on left side. Like that, they'll have some modification. No? That's what led over here. So after some point of time, you have increased the labor time by 50 hours. And for this 50 hours, you're charging 100 rupees extra. So now you're thinking you need 50 hours extra. And for this 50 hours, you're charging 100 rupees extra. That means this is 5,000. Okay. Now, how should you do this contract modification? So simple, sir. Has the new goods or service come in? No. The new service is still in old infrastructure only. You're not doing any new infrastructure. So new service has not come in. The moment that has not come in, can you treat this as a separate contract? No. That means you'll have to do it on cumulative catch-up basis. How cumulative catch-up basis works is totally how many hours? 200 hours initially, 50 hours now extra. So totally 250 hours. What is the total revenue? 30 hours here, 5,000 here, 35,000. That means what is the average rate, sir? You're totally getting 35,000 rupees for 250 hours. So that means what is the average rate? 35,000 divided by 250, which is 140 per hour. Meaning the revenue now you have to book it on 140 per hour. So the revenue you should have booked at 140 rupees per hour. Sir, how many hours is already over? 100 hours is already over. That means how much revenue should be recognized, or revenue to be recognized is how much? For you need to recognize the revenue of 140 rupees per hour. For every hour, 140 rupees. This is not 140 hours. Okay. Average rate is 140 rupees per hour. How many hours is already over? 100 hours. That means you should have recognized a revenue of 14,000. But you already booked a revenue of 15,000. That means what you have to do? Revenue you need to reduce by how much? 1,000. This is what we mean by cumulative catch-up basis. Meaning revenue will, when you do cumulative catch-up basis accounting, revenue will either be increased or decreased. Here you have recognized more revenue. That's the reason you will reduce it. Okay. This is what we mean by cumulative catch-up accounting. Okay. All right. So this is good. So let's go for the next aspect. This is done. What is the next two? 1 second. Next step, sir. First, identifying the contract is over. Second one is identifying performance obligation. Performance obligation means what? Performance obligation is simply a promise made in the contract with the customer to transfer a distinct goods or service or series of distinct goods or service which are substantially same and have the same transfer pattern to the customer. Okay. So what is this, sir? Sir, simply performance obligation means promise, sir. how many promises have you made in the contract? In layman simple terminology, if I have to say, performance obligation simply means a promise. We have promised, the entity, the seller has made how many promises to the customer. That's what we mean by that. Okay. So first we'll decode it. This promise is to transfer a distinct goods or service. Distinct goods means separate goods or service. When can you say it is a distinct goods or service? When the customer can use on its own. We saw even low value assets. That same condition. When the customer can use the assets on its own and the assets are not highly interrelated and interdependent. And assets, the customer can use asset on its own, and the goods are not highly interrelated and interdependent. Okay. Excuse me. Sir, let's say you made a contract to sell. You are an electronic dealer. You made a contract to sell a fridge and you made a contract to sell TV. You made a contract. Okay, you are an electronics dealer. You sell electronic equipments. You made one contract to sell a fridge as well as a TV. Now, sir, in this contract, how many promises are there? One or two? Two. Why? Sir, this fridge and TV, are they same or are they different? They're different. That's what we mean by distinct goods or service. To say something is distinct goods or service, no, the customer should be able to use this goods or service on their own. Sir, to use a fridge, you need TV also. No, customer can use fridge separately. Customer can use TV separately. Yes, that means they can be used separately. And they're not highly interrelated or interdependent. Okay, if you switch on TV means you should switch on fridge also. Or nothing like that. You can use one. You need not use another one like this. Or you can use both. You can use none. Your choice. I mean, they are not highly interrelated, interdependent also. You can use them independently also. So if this is a case, means we say it is a distinct goods or service. Distinct goods or service means separate goods or service. So in this contract, we have two promises like that. Okay. Or another example, if you want to say, let's say we want a broadband. We approached Reliance. We told we bought broadband service. So they told, yes, we will give you broadband service. I wanted internet or broadband. So I approached them and they gave me broadband service. They told, if you want broadband, you need to buy modem modes. You need to buy modem modes. Now, sir, check. There are two promises. One, they'll give me a broadband connection and they'll give me a modem. Now that means how many promises? Two? No, it's only one. Why? Sir, check, sir. To get the broadband, I have to use the modem. And can I use any other modem? I asked Reliance people, I already have modem. Can I use that? No, Reliance told, no, if you want our internet connection, you should use our modem only. Other modems won't work. That means what? These are highly interdependent and interrelated. Okay, one cannot be, you can't get an internet connection without Jioka internet connection, you cannot get without Jioka modem. So they're highly interrelated and interdependent. Okay, so though the promise could be like one internet connection, one modem, okay, they cannot be used on its own. That means this is not a distinct goods or service, they are one like that. Okay, so here, though the contract will say two, you will treat them as one performance obligation because of their interrelationship. Okay, people, this is one. Second one is series of distinct goods or service which are substantially same and have the same transfer pattern to the customer. So what does this mean? Let's take the example of a mango dealer. There is a mango dealer who sells mangoes. All right. Sir, we bought, let's say 50 mangoes from this particular dealer. So think from that mango dealer perspective, that mango seller perspective. Mango number 1 is different from mango number 3, is different from mango number 40, is different from mango number 50. That means each mango is separate. Correct. That means now, sir, in this contract, we have 50 performance obligations. Yes, because performance obligation means a promise to transfer a distinct goods or service. Obviously, each mango is distinct. Correct. Every mango will not look the same. It will not taste the same. Correct. Yes, no, people, though you may call it as Raspuri, Todapuri, whatever, but still, there will be a slight difference and they are all separate only. Yes, that means there are 50 performance obligation here. So if there are 50 performance obligation means 50 times you have to apply revenue recognition guidelines. Okay. Now imagine if a mango dealer has 5 lakh mangoes. That means for each mango, he'll go on passing journal entry for revenue. No, that will be wrong. Correct or not? Hence, they brought in one more thing in their definition. The same series of distinct goods or service which are substantially same and have the same transfer pattern to the customer. So in this particular case, though there are 50 different mangoes, they're all more or less mango only. No, they're substantially same only. And each mango dealer will sell separately. No, all the 50 mangoes, he'll put it in one box and he will give it to me. Yes or no? That means what? They're substantially same and have the same transfer pattern. The way of distributing them or selling them is also more or less same. If this is the case, means we will not treat them as 50 performance obligation. We will treat them as single performance obligation. So meaning we'll apply the revenue recognition criteria only once. The 5 steps of revenue recognition is there. No? We'll apply only once. Not for the 50. You know? Because that will become crazy. Yes or no? So that is about performance obligation. So performance obligation means what? It's a promise made in the contract. It's a promise made in the contract with the customer to transfer a distinct goods or service or a series of distinct goods or service which are substantially same and have the same transfer pattern to the customer. When can you say goods or services are distinct? When they can be used on its own and they're not highly interrelated or interdependent. Okay, that one. All right, next is the consignment arrangement. So if there is a consignee arrangement, means there will be a consigner and consignee. Consigner is the owner of the goods. Consignee is basically agent. So if consigner sends the goods to consignee, if consigner sends the goods to consignee, can consigner recognize revenue? When consigner sends the goods to consignee, can he recognize the revenue? No, revenue will be recognized only when the goods have been sold by the consignee to the third party. When you send the goods, when consigner sends the goods to consignee, you cannot recognize the revenue. Only when the consignee sells it to the customer, that is when you will recognize the revenue. Okay. So how do you know he's a consignee? Okay. First of all, how do you know whether it is a consigner or consignee? Consigner is that person. If you want to say it's a consignment arrangement, then the entity or the consigner is the entity we're talking about. They should have a control over the goods. In case of consignment arrangement, entity, the consigner will have control over the goods because he's the real owner of the goods. No, he'll control the goods. And two, he has the right. If the consignee in this is an agent, right? If the agent is not able to sell it to the customer, the consignee, the agent, if he is not able to sell the goods, what will the consigner say? Consigner will say, give back the goods. If consigner is not able to sell the goods, consigner will say, give back the goods. Or maybe let's say we have one agent here and we have another agent here. In the same locality, we have two agents. Either the consigner may say, the consignee, give back the goods, or give the goods to second consignee. Okay, like that also. So that's what we mean by that. The right to return the goods or transfer the goods to any third party. So the consigner will have the right to ask the goods back from the consigner or ask him to give it to some other third party. And the dealer has no unconditional right to pay for the goods except for deposit. So if consignee does not sell the goods, so should consignee pay the consigner for the money? No. Consignee will pay the money to the consigner only if he sells the goods. Okay. So that unconditional obligation to pay, consignee should not have unconditional obligation to pay to the consigner. Okay. Consignee will means only what we're trying to say is consignee will only have to pay the consigner only if he sells the goods. If he doesn't sell the goods, he'll return the goods back. He'll not give any money. But except in case of security deposit. Normally, when consigner sends the goods, no, it's a normal practice that they may ask some consignee to pay some security deposit, some surety amount, just in case he doesn't run away with the goods and all that stuff. Especially when you're dealing it for the very first time and all, some security deposit may be asked. So these are the features of consignment arrangement. But overall takeaway is we will recognize the revenue only when the consignee sells the goods to the customer, not before that. Till the consignee sells, it is our own inventory. We have to show it as our own inventory only. Okay. All right. The next consideration is towards principal and agent. So why the distinction is important is, first, if you are a principal, you'll recognize the revenue at gross amount. If you are an agent, you'll recognize the revenue at net amount. That's the reason it's very important to know whether you are a principal or whether you are an agent. Like, let's take a small example. Let's say there is an Indigo Airlines. Okay. This airline ticket is sold by, let's say, one agent called A Limited. Now, A Limited, no sir, is selling the ticket of Indigo Airlines to the customers. Okay. Let's say the ticket price is 5,000 rupees. And if A sells one ticket, he will get 500 rupees commission. If A is selling one ticket for 5,000 rupees to the customer, and if he sells one ticket, he will get 500 rupees commission. Now, if A Limited is the agent, then he will recognize revenue only for 500. He will recognize revenue only for 500. However, if A Limited, if you conclude he is a principal, then you will recognize the revenue at full amount, which is 5,000. Like that. That's the difference. So 5,000 here is a gross amount, 500 rupees is a commission amount. So if you are a principal, you will recognize revenue at full amount. If you are an agent, you will recognize the revenue at commission amount. That is a net amount. Okay. So how do you do whether he's an agent, principal or agent? So if you want to say that you are a principal, there are certain conditions. There are certain conditions using which you can decode whether you are a principal. Okay. Basically, principal is that guy is that entity who's primarily responsible for fulfilling the contract. That is one. Okay. The second one is principal is that person who bears the inventory risk. This is the major criteria. Okay. Principal is that person who bears the inventory risk. Inventory risk means before sale, whether the sale will happen or not. After sale, whether the goods will get returned or not. That was a risk. Because if you have a product, the principal will always have one worry. Will I be able to sell this goods or not? After selling also, he will have one more worry saying whether the goods will get returned or not. So principal is that guy who will have this worrisome factor. Okay. Agent will not have this worry and all because he's working for commission. Okay. And principal is that entity who decides the price of goods or service. So you'll have to decode based on these parameters. This depends on facts of the case. Okay. The same example I can modify and make it as agent also. You have to analyze the Facts of the case, and then decode he's an agent or principal. Like in this example, let's say A Limited purchased the ticket from Indigo Airlines. A Limited purchased the ticket from Indigo Airlines. After that, they are selling it to the customers. If A Limited does not sell the goods, means A Limited only will bear the loss. First, A Limited will purchase the goods from directly from Indigo Airlines, then they will sell it to the customer. If A Limited is not able to sell the goods to customer, means A Limited only will bear the loss. If that is the case, means A Limited becomes principal. In that case, A Limited, when they purchase the goods from Indigo Airlines, they'll account purchase. When they sell these tickets to the customer, full amount, they'll record it as sale price. That is one case. However, A Limited is just acting as an agent. If they took the ticket from Indigo Airlines, okay, if they sell, they'll get commission. If they don't sell, they'll not give any money to Indigo Airlines. Only if they sell the tickets to the customer, Indigo Airlines, A Limited will pay the money to Indigo Airlines. If they don't sell, they will not pay any money. If that is the case, means A Limited becomes an agent. So you'll have to analyze based on the facts of the case. Okay, just by looking at an example, you cannot decode. You'll have to look at more data there. Okay, so basically the factors are: principal is that guy who's primarily responsible for fulfilling the contract. Principal is that guy who bears the inventory risk, like whether the sales will happen or not. Say after sale, whether it will get returned or not, like this. And principal is that guy who primarily decides the price of the goods or services. So that is one. Okay, the next one is non-refundable upfront fees. Non-refundable upfront fees. Sometimes, in some contracts, upfront fees will be collected. Like gym. This is a normal example. Like, okay, so let's say you joined a gym. Okay, you took 1 month membership. You paid 5,000 rupees for 1 month membership fees. Okay, let's say gold gym or cult gym, whatever gym it is. Okay, you took 1 month membership by paying how much? 5,000 rupees. But that cult gym or gold gym, they are also asking you joining fees, one-time joining fees of 2,000 rupees. If you want to join, your first time you are joining the gym, so they are asking you one-time joining fees of 2,000 rupees. Now, this 2,000 joining fees, is it a separate performance obligation is what we are testing. Okay. This joining fees of 2,000, is it a separate performance obligation? Generally, no, but you'll have to have more. Generally, normally they'll not give you any further information in the question. So generally we say this is not a separate performance obligation, because if you want to say separate performance obligation means you should get some goods or service, right? You should get some goods or service. Now in this particular case, you can probably decode this example 2 ways. Sir, you paid joining fees. You paid joining fees of 2,000. The gym gave you gym kit and all. They gave you gym bag, a gym water bottle, 1 napkin, blah, blah, blah and all they gave. Gym kit you received. You paid gym joining fees of membership, joining fees of 2,000, and if you receive gym kit receipt, so you paid 2,000 and you're receiving goods or service. So think from the other company angle. All right, they received 2,000 and they're transferring you some goods or service, that is gym kit receipt. In that case, it will become a separate performance obligation. Okay. So suppose that particular company, the cult gym or Reliance, Gold gym, they collected 2,000 rupees joining fees from you, but no goods or service they gave it to you. Nothing. They just collected. That's all. Go in there. That's all. Okay. So if no goods or service are received, then it is not a separate performance obligation. Okay. So most probably this scenario will be more popular in examination, but again, just check what it is. I'm not saying this will come, just saying. Okay. So if you have not received any goods or service, then it is not a separate performance obligation. Rather, it becomes an advance for future goods or service. Okay. So if no goods or service they have transferred means you cannot recognize this 2,000 revenue immediately. They are saying this 2,000 is paid for the future. It's like an advance paid for future goods or service. Here, future goods or service is gym membership. So that means gym membership, how many months did you take? 1 month. That means this 2,000 of revenue, you cannot recognize it immediately, because you can recognize revenue only when performance obligation is satisfied. From the gym perspective, the performance obligation is satisfied only when the 1 month is over and customer utilizes the services or the gym ka facilities. Yes, no? The gym ka facility ka utilization will happen after 1 month. So that means the gym will treat this as an advance. Though they have received it today, they will have to treat this as an advance. After 1 month, when the 1 month membership is over, from advance account, they'll have to transfer it to revenue account, like that. So it represents advance for future goods or service. You will recognize revenue only when that goods or services are provided, like that. Okay, so you have to analyze this factor. So if no goods or services are received, then it does not become a separate performance obligation, like that. However, if goods or services are received means it does become a separate performance obligation, and they've already fulfilled their promise. They collected 2,000 from you and they gave the gym kit. That means whatever is their obligation, they've already fulfilled. That means the revenue for this 2,000 in this case, revenue of 2,000 can be booked immediately, because whatever is their obligation, they've already fulfilled, like that. What about this 5,000, sir? This 5,000 revenue, it's for gym 1 month gym membership fees. No, only when 1 month is over, obligation will be completed. In that case, after 1 month, you can book the revenue. Till then, you cannot book it. Okay. Even if you have already received the money, you have to show it as advance. After 1 month, book it as revenue. Okay. All right. That is one. CA Inter Marathon will be done. Yeah, first let me finish this. Yes, it will be done. It will be done in the next week onwards. Okay, CA Inter students don't need to log into this mode. I will do it. It will be announced also. Don't worry. Probably next week. Yes, both advanced accounting, FM, both I will do it. Do not worry. Do not come in between and tell all this. Yeah, I'll do. It will be info. So many people of CA Inter students are logging in between. Yeah. Okay. Next is the third step is the transaction price. We saw first step is identifying the contract. Second step is identifying performance obligation. Third step is finding out the transaction price. Transaction price is a contract price. So what's the big deal about transaction price? It will anyway be given. No. It's not straightforward. Okay, first the transaction price does not include taxes. If there is any taxes included, okay, you have to exclude that. That is one. Okay. Other than this also, there could be some extra drama around transaction price. So what is that, sir? One is something called variable consideration. So let's look at a small example. Excuse me. Sir, there is a construction contract. Earlier, if you remember in CA Intermediate, you had Accounting Standard 7, which talked about construction contract. Accounting Standard 9, which talks about revenue recognition. Now, we don't have two standards. Even construction contract revenue and normal revenue. Both are accounted as per IND AS 115 only here. Okay. We don't have any separate standard for construction contract. Both comes here only. Now, visualize. There is a construction contracts. We are the contractors, the architects. We build the building. That's our line of business. Then we build for our customer approaches us. We build we construct the building as per their specifications, and we will collect the amount. So whatever money we collect, it's the revenue for us. Okay. So let's say we are a construction company. We have made a contract for a price of 2 crore rupees. So we'll construct the building and we'll get 2 crore rupees. So that's the contract price mentioned in the agreement. But this contract, no sir, has one more clause saying we told the customer we need about 2 years to construct this building. Okay. But this contract has one extra clause saying if you construct the building within 18 months, the term required for me is 24 months. Okay. But the contract has one more extra specification. The customer is saying if you construct the building within 18 months, the quality construction, if you do within 18 months, you'll get an extra bonus of 30 lakh rupees. If you construct it within 18 months, then you will not get just 2 crores. You will get 30 lakh rupees extra. In that case, it will become 2 crore 30 lakh rupees. Now, what is the transaction price? Is it 2 crore or is it 2.3 crore? Is it very straightforward? No. Yes, you may have these sort of things. That's a reason in transaction price also you should be a little careful of. Okay. This is what we mean by variable consideration. Okay. This 30 lakh, this bonus, we call it as VC. VC as in variable consideration. Okay. So whenever there is variable consideration, whenever you have variable consideration like this bonus, incentive, etc., this variable consideration can be added to the transaction price. So this 30 lakhs can be added to the transaction price of 2 crore. Okay. Provided the entity is reasonably sure that revenue recognized will not get reversed subsequently. I'll read this line once again. Variable consideration can be can be added to the transaction price provided it is highly probable that revenue recognized will not get reversed subsequently. Meaning what the standard is saying says you add this to transaction price, add variable construction to transaction price and make the transaction price to 2.3 crores. We have no issues. But don't add it now and later on don't reverse saying we will not get this. Okay. Because everybody wants to recognize more and more revenue. More and more revenue, you recognize more and more income. So obviously better will be the position of the company. Okay. So Josh, initially you don't add off. And later after 12 months or 14 months, you say we will not be able to construct the building within 18 months. That means this 30 lakh, whatever we added, we will reverse. That should not happen. Okay. You can add this variable consideration provided organization is reasonably sure that they will not reverse this revenue later. Okay, as long as they get that assurance, they can go ahead. I mean, this is basically the onus is on the management to estimate this. Okay, sir, on the day one, if they don't have a reasonable assurance that they will receive this 30 lakh, then don't add. Suppose they got this assurance in the 3rd month, then add it like this. The day your organization become reasonably sure that they will receive this 30 lakh, meaning they will be able to complete this work within 18 months and receive this 30 lakh, that day variable consideration can be added to the transaction price. Till then, don't add it. Okay. Then certain factors may indicate that the reversal of revenue may happen. Meaning certain factors may indicate that you should not add variable consideration to transaction price. What are those certain factors? One is very volatile market. If the market there is too much of fluctuations, especially like, sir, obviously in construction contracts, you need labors, you need materials, and you need all that stuff. Okay. If it's a very volatile market, if the price is dynamic, sometimes we may not get the desired quality product within time and all. So if it's a very volatile market, or if your contract is highly susceptible to the weather conditions, let's say you're constructing this building in like Meghalaya or Leh Ladakh, etc., where you get heavy rainfall or landslides and all that stuff, then will you be able to complete this? Even if you may have the capability to, you have the necessary expertise to complete within 18 months. But does the nature allow you to complete it? Probably no. So if you are highly dependent on weather conditions, or if there's too much of technology risk, then if these factors are there, indirectly, these are assessments, okay? If these are there, then what as an organization you should do is, you should not add variable consideration to the transaction price, because these factors may indicate that even if you add now, you may have to reverse it later on. That is one. Or if it's a long-term contract. So if the contract period is 1 or 2 years, you can probably make an estimate whether you'll be able to get this variable consideration or not. Okay, let's assume instead of 2 years, I make this as 20 years. Then, so 20 years is a very long period of time. Yes, especially sophisticated building you're constructing, like Burj Khalifa, a bigger building than Burj Khalifa you're constructing. I mean, that may take around 10-15 years also, no? Right? You may have some incentives like this. So since the contract period is long, organization may not have expertise to determine whether they will be able to receive this variable consideration today only, at contract inception only. Okay, so that is what they're saying. If these are there, means be a little careful before adding variable consideration to the transaction price. Standard is not denying the addition, it only says be a little exercise extra caution. Okay, and entity has less experience in this product or services. Suppose we are getting into a new line of business. So suppose earlier we were doing something else. Now we got into the construction business. That means we don't have much expertise in this. Okay, if you don't have much expertise, it's better that you don't add this 30 lakhs now. The day you get reasonable assurance, that day you add it, like that. So these are the some factors which tells you that you should exercise little more caution before adding variable consideration to the contract price. Okay, all right. Sir, you may have to estimate variable consideration sometimes, because sometimes what happens in the contract, no, it may not be very simple amount. They may give you, like the customer may say, if you complete within 10 months, you will get this much bonus. If you complete within 12 months, you will get this much bonus. If you complete within 18 months, that much bonus. That means you may have various amounts. So if you have multiple outcomes, you may have to estimate variable consideration. And if you have multiple outcomes, we use a method called expected value method to find out the variable consideration. In this expected value method is used in case of multiple outcomes. Okay, normally what they'll do in these sort of questions is, they will give you the amount and they'll give you various probability factors. They'll give you amount like 1 lakh, 2 lakh, 3 lakh, and they'll give you probability factors. Let's say like 50%, okay, 30%, 20%. So just simply take the amount and multiply by the probability factor, and you will get the variable consideration amount. If you sum it up, you will get the variable consideration amount. That is your expected value method. Or if the contract has only one outcome, that either you will get everything or you will not get anything. It's simple. If you achieve the milestone, you will get full amount. If you don't achieve the milestone, or if you don't achieve the target, you will get nothing. It's like our result. Either you pass or you will fail, nothing in between. Okay. So if that is the case, means we will use most likely amount. Okay. So if you have only two outcomes, whether you will get or you will not get, in that case, we will use most likely amount basis. Okay. That's about variable consideration. All right. Next is sale with right to return. Sale with right to return. What does it mean? Sir, we as an organization, we have sold some goods, okay? But the customer has a right to return the goods. Like obviously, if you buy the goods on Amazon and all that stuff, we get some 10 days, 15 days, within which if you want, as a customer, we can return the goods to Amazon, like that. That particular scenario, we're calling it as sale with a right to return. We already sold goods to customer, but customer has an option to return the goods. Normally, some time frame will be defined. Maybe 1 week, 2 weeks, 1 month, or whatever. If that is the case, means what to do? So should we wait for the time limit to expire, or can we recognize the revenue immediately is the question. So what the standard says is, first, it's a simple process. First, find out how many units of goods have you sold to the customer in totality. Okay. Let's say, let's take this example. Let's say Flipkart has sold 100 TVs to the customer for 50,000 each. So the total will be, that will be 50 lakh rupees. Oh, yeah, 50 lakh rupees. Okay, the cost of this TV is 45,000. Flipkart has purchased for 45 and they're selling it for 50, let's assume. Okay, how many TVs have they sold? 100. Flipkart, based on their past experience, feel about 10 TVs will normally get returned. The customers will, on an average, return about 10 TVs. That's their past experience. So what IND AS 115 says is, first find out the total quantity of the goods sold, which is 100. So in this 100 goods, you have to estimate, entity has to estimate how many goods are expected to get returned and how many goods are not expected to get returned. So in this example, Flipkart feels 10 TVs are expected to get returned. That means in 100, 10 are expected to get returned means 90 are not expected to get returned. On those quantity of goods which are not expected to get returned, which is 90, on that you can go ahead and book the revenue. On those quantity of goods where you are not expecting the return, okay, on that you can go ahead and recognize the revenue. On this 10 TVs which Flipkart feels will be returned, it is not returned yet. Flipkart feels it will be returned. So the revenue relating to 10 TVs should not be accounted. It should not be recognized immediately. So if you already received the amount, what to do? Look at this journal entry. You already received the amount for 100 TVs. So bank account debit 100 into 50,000, which is 50 lakh. But can you recognize the revenue on all 100 TVs? No. In that 10 are expected to get returned. That means only 90 are not expected to get returned. On 90 you can book the revenue. So 90 into 50,000, which is what? 45 lakh rupees. Balance 5 lakh rupees. No, sir, you will show it as an advance. You will show it as an advance. So what will you do with this advance? So you will wait for the time frame. Let's say time given to the customer to return the goods is 2 weeks. So you will wait for 2 weeks. In 2 weeks, if the customer does not return from advance account, you will transfer it to revenue like that. Okay, fine. If a customer is already customer returns the goods means obviously pay him money in the bank. Then it will be advance account debit to bank account, matter closed like that. Okay, fine. Then another one, not only this, this we call it as refund liability. Standard uses the term as refund liability on this. Not only this, sir, you have a right to receive the asset. You not only have to give the amount. If customer returns the product means you not only have an obligation. See, if customer returns the goods, and Flipkart has an obligation to pay him the money. They just don't have obligation. They also have a right. Right to what? To collect the TV. So that means the right to receive the TV also you will account it. But the right to receive the TV is your inventory, sir. TV is your inventory, no? Don't record it at selling price. Record it at cost price. So what is the cost price? 45,000. How many TVs? 10 TVs. So right to receive the account, this is basically your inventory. You'll record it at 4,50,000 and inventory will be sold in cost of goods sold. No? So you'll show it as inventory account debit to cost of goods sold. Like that. Fair enough? You not only have obligation, but you also have a right to receive that. You right to receive your goods, which is an inventory. So you'll record inventory account debit to cost of the goods sold. But this, mind you, will be recorded only at not the selling price, but at the cost price. And in this example, I've assumed the cost price to be 45,000 on 1 TV. So on 10 TV, it will be 4.5 lakh. That's all is the drama around this particular aspect. Sale with right to return. They will give you all the facts. You just need to recognize this. Quote one provision, write this entry or explain this in words. You will get 3 to 4 marks if at all they ask you. Okay. All right. The next is like this in revenue recognition of people. Many people freak out on this particular topic. IND AS 115. Actually, it is not. Okay. Hardly 2-3 questions, maybe a little bit of bouncer here and there. But the thing here is you have a lot of small concepts. That's all. Okay. But most of them are pretty straightforward if you ask me. Okay. So you just have to, I mean, even if you don't know something, no, at least you can write the provision and get 1 or 2 marks. Okay. That's what I feel. That's where you should be a little more smarter. Okay. It's not about knowing everything. So CA examination, see, all of us now became chartered accountant not by knowing and writing everything. We didn't get 100 on. Even now I'm teaching accounts. Doesn't mean that I got enough 100 on 100. Yes. Nobody got that. Yes. All right. So, but the thing is, whatever you know, you should know it perfectly. So every people, whenever any student for that matter, when he writes the examination, about 60-70 marks, like he properly knows. Another 30-40 marks, no, he has made some estimate because 1 or 2 questions in every attempt. Doesn't matter who's writing the exam, right? In every attempt, some questions, some around 25 to 30 marks questions will always be a little tricky. That's always been the case. Okay. So in that 25 to 30 marks, no, try to get what, sir? Answer how much ever you can within the limited time also. All right. Try to score some there. But in about 50-60 marks, that will be mostly what, sir? Past paper question, study material question, RTP question, MTP questions. So there, that is where you need to score high. So think on those. Where in that particular area, whatever you know, no, perfect. Practice that properly so that you don't do much mistakes. You get very good amount of marks in that particular area. Okay. So what many students know is this 60 marks may also, they don't know much. Okay. They have not practiced much. They commit a lot of silly mistake. Here also they lose marks. Anyway, that 30 marks or 25-30 marks is anyway tricky. There also they lose marks. Then they'll come out and say paper is very tricky. Nothing understood. Nothing came and all that stuff. In every attempt, some questions will always be tricky. So you need to be a little smart work. So don't have to know everything again, but whatever you know it pakka. So that there you get very good marks. Out of 10 there, out of 60-70 there, at least you should score 45-50. Like that. That level of accuracy, precision is required there. If you have that in every paper, pakka aram se you will become chartered accountant. There is no doubt about that. Yeah. All right. So work towards that. All right. Let's come back to this particular topic now. Warranty. Sir, if you have warranty, first check whether it is an assurance type warranty or service type warranty. Assurance type warranty means it's a warranty given to make sure that the product works as per the specification. Normally, that's the case. No, sir. If you buy a laptop, they'll give you a warranty of 1 year. So if something happens within 1 year, the seller will repair that particular product, or the manufacturer will repair the defects, or he'll either repair the product or he'll replace the product. Yes, so that is a warranty, means it's an assurance type warranty. Assurance type warranty simply means it's a extra assurance given that the product will perform as per the specification. Whichever way the product should work, it will work. That is what we mean by assurance type warranty. If it is assurance type warranty, you don't have to do anything. If by chance there could be some provision and all required on this, that we'll study in IND AS 37. So that it is out of IND AS 115 scope. So you don't have to do anything. All right. However, if it is a service type warranty means it's an extended warranty. If you just check now, no, normally whenever you buy any goods now, especially mobile, laptop and all, they say, do you want extra warranty or extended warranty? Or warranty comes 1 year, but if you buy, you can also extend the warranty by 1 more year by paying 500 rupees extra, like that. So that extra warranty, we calling it a service warranty. Service warranty is nothing but your extra warranty, which the customer has to buy it separately. Since if customer is buying separately, means it represents a separate performance obligation, because customer is asking for it separately. It's a separate service he's asking from you. That means it represents a separate performance obligation. So if it is a separate performance obligation, you have to do revenue recognition ka step. Whatever is the transaction price, some portion of transaction price has to be allocated to this performance obligation also, and revenue has to be recognized only when the performance obligation is satisfied. We'll talk about the allocation part in a bit. Okay. So if it is a service type warranty, basically it represents a separate PO. If it represents a separate PO, then you will have to do some revenue recognition ka steps, which we'll talk about in further. We have not come to the allocation part yet. Okay. So that's about the warranty aspect. Next is sales based or usage based royalty. Now, what is a sales based or usage based royalty? Let's take an example. Let's say there is Mr. A. He's the author of one book. He's the author of one book. Like he wrote one book, how to clear CA examinations with a rank. Okay. Or how to score a first rank in CA examination. Like that, he wrote one book, one author. All right. Author obviously writes the book. He'll not publish the book. So this book rights, no sir, he transferred to one publishing company. Let's say Z. So A Limited and Z Limited entered into a contract, and the book publishing rights, A Limited transferred to Z Limited. The rights was transferred on 1st January 2024, let's assume. Okay. And later on what happens? And they have, A and Z have agreed that on the book sale, A will get 10% as royalty. How much ever sales has been made by Z Limited, how much ever books Z Limited has sold, no, of this particular author ka book, 10% of that will be paid to A as royalty. That's the agreement. Okay. Now, if you just check, what does revenue recognition ka standard say? You can recognize the revenue when performance obligation is satisfied. When your obligation you have satisfied, when the seller satisfies his performance obligation, when he has fulfilled his promise, revenue can be recognized. Now think from Mr. A's perspective. He's the author. He's getting royalty, means this royalty is part of his business. That means that's his revenue. And Mr. A has already transferred this book rights on 1st January itself. That means his performance obligation is got satisfied on 1st January only. So can Mr. A recognize the revenue on 1st January only? No. Why? Sir, this is a usage based royalty. So how much ever books Z sells, based on that A will receive royalty. Yes or no? So on 1st January, only rights have been transferred. Has Z already published the book? No. He's only got book published rights. Later on what, sir? He will publish the book. After publishing the books, he will market the books. He will sell it. Yes, no. Let's say sales was made by Z Limited to the extent of this books was sold by Z Limited for 10 lakh rupees on 1st March 2024. Z got the rights on 1st January, but sales was made only on 1st March. How much value of sales? 10 lakh. That means how much royalty A will get? 10 lakh or 10%, which is 1 lakh. So when should A recognize this revenue of 1 lakh? On 1st January, yeah? No. Though A has satisfied his performance obligation on 1st January, he can recognize his revenue only on 1st March. That is the date on which the sales got made. So that means this is a specific or exceptional case. In case of sales based or usage based royalty, you will recognize the revenue on the date of performance obligation or on the date of sales, whichever is later. Performance obligation date or the sales or usage date, whichever comes later. So here 1st January or 1st March, whichever is later. Which comes later? 1st March. So A will recognize the revenue only on 1st March in this particular case. Only when the sales happen. Before that, you cannot recognize the revenue, though performance obligation is satisfied. So this is a little exception to the IND AS 115 ka normal rules. Okay. All right. The next one is SFC. SFC as in significant financial component or significant finance component. What is a significant finance component? So simple. Let's take a small example, or maybe let's look at it here only. let's say, sir, A Limited, one second. Sir, A Limited sold goods to B Limited. Okay. Excuse me. 1 minute. Let's take this example. Maybe first we'll do this. Sir, A Limited sold goods to B Limited. Okay, fine. All right. Now, the goods ka worth is, let's say, 15 lakh rupees. Normally, A gives 2 months credit. Normally, A sells the goods and he gives 2 months credit. The worth of the goods is 15 lakh today. But B told, I will make the payment after 2 years. Not after 2 months, after 2 years. Okay. Probably he misread the words. Okay. So A Limited has already sold the goods. He has delivered the goods to B Limited. But B Limited will not make the payment now. He'll make the payment after 2 years. Normally, A sells his goods for 15 lakhs and he'll only give 2 months credit. But here, B settling the payment after 2 years means A is giving 2 years credit. So now, do you think A will charge only 15 lakh? Oh, no. After 2 years, let's say B Limited pays to A Limited 17 lakh rupees. 17 lakh rupees. Okay. This is the arrangement. So in this case, revenue should be accounted. We are talking from seller perspective. So for seller, it's a revenue, right? So A Limited should record the revenue at 15 lakh or 17 lakhs. 15 lakhs or 17 lakhs. At 15 lakh rupees. So this is what we mean by significant finance component. Okay. Significant finance component means significant finance. Maybe I'll give you an overview and then come back to this example again. Significant finance component, sir, normally occurs where there is a deferred consideration or there is an advance received transaction. Deferring the consideration means we have sold the goods, we have delivered the goods today, but money will receive it later, after 1 year, 2 years, 3 years, like this. Or other way around, we have received the money now. The seller has received the money now, but he will deliver the goods after 2 years, 3 years. So advance received now only, but the goods ka delivery will happen later on. So in these sort of transaction, SFC, as in significant finance component, may come. Not necessarily it will come, it may come. Okay. So this is the thing. So in case of SFC, the benefit could be either to the entity or to the customer. So if entity receives the money now only, and entity means seller. If seller receives the money now only and delivers the goods later on, means it is beneficial to the entity because they got money now itself. Or entity, the seller gives the goods today, recovers the money later on, means for it is beneficial to the customer. So SFC could be, transactions could be benefiting the entity, the seller or the customer, it doesn't matter in both cases. Okay. What IND AS 116 says is revenue should always be recognized at cash selling price. Revenue should always be recognized at cash selling price. Cash selling price means the day you satisfy performance obligation, find out what is the value of the goods. The day you satisfy performance obligation, what is the value of the goods? Okay. In this particular example, A delivered the goods today only. So A ka promise, A is the seller, right? Right. So performance obligation is satisfied today only. So today only, if A has sold, means what is the worth of the goods? 15 lakh. So that means the cash selling price in this case is 15 lakh. So revenue will be recognized by A Limited to the extent of 15 lakh only. But how much is A receiving totally? 17 lakhs. The difference between these two will be what, sir? It will be nothing but your time value of money ka interest income, which A is receiving. So this 2 lakh rupees, A should account it in my example as a interest income, not as a revenue. Is that okay? It should be coming as an other income. So revenue will be recognized only at cash selling price. Cash selling price means the day on which the performance obligation is satisfied. Performance obligation is satisfied today only. So today's value of the goods is 15 lakh, like that. If it's other way around, look at this example. Amount received now. The seller has received the amount from the customer now only. How much? 10 lakh. But the goods will be delivered after 2 years. Goods will be delivered after 2 years. That means performance obligation. Performance obligation means to deliver the goods. Has delivery already happened? No, delivery will happen after 2 years. After 2 years, the value of the goods is 13 lakh. Now tell me, what is the cash selling price? Cash selling price means the value of the goods on the day performance obligation has got satisfied. Here PO is getting satisfied after 2 years. So after 2 years, value of the goods is 13 lakh. So the cash selling price is 13 lakh. That means the revenue will be recorded at the 13 lakh rupees only. So revenue will be recognized by the company in this case is 13 lakh. Sir, but they received only 10 lakh, no sir. So in this case, what journal entry they'll pass is, they've received 10 lakh, no? So you'll pass the journal entry, bank account debit to advance account 10 lakh, 10 lakhs. This is one. All right. Fine enough. This is the present value. Okay. But you're delivering the goods after 2 years. No? That means the difference. What is the difference between this 10 lakh and 3 lakh? The difference between 10 lakh and 3 lakh is 3 lakh rupees. So that will be, this is an advance. Now advance is like your financial liability. On this financial liability, you have to book interest charges. So for 2 years, the company has to book interest charges. So they will pass the journal entry. interest charges account debit 3 lakh rupees. Okay, every year so and so breakup. You have to put up ACM table over here. That will give you each year kind interest. I'm not getting into that. Okay, total interest for 2 years is 3 lakh. So interest charges account debit to advance account, which is 3 lakh. That means what is the balance in advance now? 13 lakh. Okay. So this is one. And second year, when the performance obligation is satisfied, you will pass the journal entry advance account debit 13 lakh to revenue account 13 lakhs. So this is your setup of your journal entry. Basically, revenue has to be recognized at cash selling price. Okay, that's what, if you remember, it's okay. So the difference between the transaction price and cash selling price is nothing but your interest charges or interest income. Could be whatever, depending on case to case basis. Okay. So that interest charges, that interest portion only, we're referring to as significant finance component. Finance component here refers to that interest component. Doesn't matter whether it could be an interest charges or interest income. Not only that interest income or interest charges only, we're calling it as SFC. Okay, significant finance component. Okay. All right. One thing that is more relevant for examination here is one shortcut. IND AS 115 has given one shortcut. What the shortcut they say is check on which day did you fulfill your performance obligation, meaning on which day did you transfer the control of goods or service. Find out that. Check on which day did you receive the payment. Obviously, we're talking about revenue recognition, so payment will not be made, payment will be received, right? So check the date of payment, received, and check which day did you transfer the control of goods or service. If the difference between these two periods, if it is less than or equal to 12 months, if the difference between this, the day you transferred the goods versus the day you received payment, the difference between these two dates, if it doesn't exceed 12 months, if it is less than or equal to 12 months, then IND AS 115 gives a practical measure saying there is no SFC. In this case, there is no SFC. You don't have to do any test. Okay. Between the day you transfer the goods, like here, you receive the payment today. You're transferring the goods after 1 year, by the end of first year. So at year 1 beginning, you receive the payment. Okay. And by year 1 end, year 1 only, this is year 1 end only, you delivered the goods. You deliver the goods. So check the difference between these two. Is it within 1 year? Yes. It is less than or equal to 1 year. Yes. So in this case, if this is the case, means the standard says no SFC. You don't have to do any test. So basically, time value of money. Interest charges you'll only book when the time value of effect is material. And we say time value of money ka effect is material when the period crosses 1 year. Right? Here, since it is less than 12 months, you don't have to book any interest charges. Interest charges or interest income, nothing needs to be accounted in this particular case. This is a practical relief, no logic and all. This is the practical relief given by in IND AS 115 itself. So you don't have to do any test in this particular case. Because sir, if you want to book interest charges and all, interest charges, you can't book it at any rate. You need effective interest rate for that. Okay. So that means it involves sufficient amount of calculations. So for every small transaction, if you say find out EIR, FIR, accordingly do the interest, means accounting will become too complex. That's the reason they've given all this small practical relief also, so that it will become easy for accounting as well. Yes, doing accounting is good, but you can't put so much of things on the client head also. No? That will also become too much. Yes, that's the reason these sort of small reliefs are given. Okay, the next is non-cash consideration. Non-cash consideration means, sir, we sold the goods. Instead of receiving cash, our customer gave us some equity shares. Okay, he gave equity shares, or instead of giving cash, he gave building, he gave machinery, like this. Instead of receiving cash, if we receive something else, we call that as non-cash consideration. So in that case, what to do, sir? Whatever non-cash consideration you have received, measure that at fair value. Find out what is the fair value. Let's say you sold the goods and you received equity shares, right? So that means what, sir? Obviously, that equity shares will have fair value. Let's say fair value of the equity shares is 10 lakh. I mean, simply you will pass the journal entry, what? Financial asset, equity shares of another entity is financial asset, no? So let's say financial asset, equity shares account debit. What is the fair value of that? 10 lakh. So you'll write here to revenue account 10 lakhs. That's fine. So whatever is the fair value of that non-cash consideration you have received, at that value you recognize the revenue. That's all, as simple as that. So what if I'm not able to measure the fair value of this? Because let's say it's not a private public company. Okay, it's a private limited company. So I'm not able to. Even private limited company valuation you can make, but by chance if you feel I'm not able to value, then sir, then just check. If you had sold these, here you have sold the goods and you have received the equity shares. No? Suppose you have sold the goods for cash only. Suppose you had sold the goods for cash only. At what value you would have sold the goods? Let's say you would have sold the goods for 9.5 lakh, you conclude. If you had not sold it for equity shares, but if you had sold it by receiving cash, how much value you would have sold it for? You need to estimate. Let's say that value comes to 9.5 lakh. then in that case, this case, you'll not measure the revenue at 10 lakh, you'll measure it at 9.5 lakh. So if fair value of that non-cash consideration, if you're not able to measure, find out the fair value of the goods. So anyway, you have goods also, no? Try to measure the fair value of the goods. If you had sold it for cash, take that particular value. That's what I've given it over here. Okay, fine. So first priority is the fair value of non-cash consideration received. If you're not able to find out that, then use fair value of the goods if you had sold it for cash, like that. Okay, subsequent changes to fair value will not affect transaction price, because if you have received equity shares means subsequently its price will go on moving up and down. So that will not affect your revenue recognition. That whatever revenue recognition you've already done, that will stay as it is. Okay, that is one. Okay, next one is customer provided goods or services. Okay. Customer gave us one goods. Like this happens normally in your jewelry business if you just check. Yes. So the customer, no, so one customer is there and one jewelry company is there. Okay. Customer has some jewelry within them already. So customer gave gold worth 75,000 to jewelry company. Why did they give? So that jewelry company can make a gold chain, okay, and give it to the customer. Okay. So that basically the jewelry company activity is to incur making charges and make a gold chain out of it. But gold is provided by the customer only. Okay. But gold ka value, let's say, is 1 lakh rupees. So the gold, the physical value of gold bar, let's say customer had a gold bar worth 75,000, which he gave it to jewelry company. The jewelry company will use this gold bar, convert it into gold chain and give it to the customer. And the worth of that gold bar is 75 and the worth of the gold chain is 1 lakh. So in this case, what to do? Should the jewelry company recognize the revenue only for making charges, which is 25,000? Because their revenue is what, sir? They received 75,000, worth of the gold chain is 1 lakh. So should they recognize the revenue only for 25,000, the difference of these two, or should they recognize the revenue for 1 lakh is the question. Okay. So this is a provision which says customer provided goods or service. Here customer has given some goods or service to you. Okay. We will use that and give the final service back to the customer. So if this is the case, means first you need to check whether the jewelry company, in this example, you need to check whether the entity, that is a seller, do they have control over goods or service? Do they have control over goods or service? If the answer to this is yes, the jewelry company has control over that goods or service, then you will treat the 75,000 as a gold purchased. You will account this as a purchase. This is your normal trading P&L account I'm showing. So you will treat the 75,000 as a gold purchased. And this 1 lakh rupees, you will treat it as sale. Meaning 75,000 you will book as purchase, 1 lakh you will show it as purchase. So the net profit will be how much? Net profit will be 25,000. That is the case. However, if you conclude that jewelry company has no control over that gold, they have no control over that goods or service, in that case, they will not recognize the revenue for 1 lakh. They will only recognize the revenue for the differential amount. What is the differential amount? 25,000. So they'll book the revenue only to the extent of 25,000 in this particular case. Like that. So that is what is the provision I've written here. If entity has control over this goods or service, then they will treat it as non-cash consideration and measure it at fair value and recognize full revenue. Otherwise, you recognize the revenue net amount. That's what is this particular example of. Okay. Great. Let's go for the next one. Next is consideration payable to the customer. Consideration payable to the customer, not receivable. Consideration payable. Sir, wrong provision, no, nothing like that. Sometimes, no, sir, we will not only receive money from customer, we may also have to pay to the customer. That case also could be there. Sir, how, sir? Sir, let's say there is one company X Limited, and then there is one company called Reliance Fresh. Reliance Fresh deals with our day-to-day goods, no, consumer goods, fast-moving consumer goods, FMCG companies. Yes. Let's say X Limited, sir. Excuse me. So they are producing Maggi ka, let's say one noodles they're producing. Okay, that noodles ka name is, this example I used to give it in my class. Yes, no Maggi. Okay, the noodle ka name is not a Maggi, no Maggi. Yeah, you remember after Maggi, people stopped buying Maggi and all. No? Okay, so this company started producing one noodle, and the name of the noodle is no Maggi. Okay, so this X Limited, sir, approached Reliance and they told, I have one wonderful product. The name of the product is no Maggi. It is not a Maggi at all. Okay, it is much more better than that, like that. Okay, and told, would like to sell it to you. Fine. Excuse me. All right. Reliance Fresh told, okay, they tested the product. They probably like the product. Reliance Fresh told, okay, no problem. Give me goods worth 10 crore. This particular, or let's say, maybe I'll take a small example. Give me this product worth 50 lakh rupees. I would like to buy this product from you for 50 lakh. That means X Limited will sell this particular product worth 50 lakh rupees to Reliance Fresh. Okay, fine. X Limited was also very happy because they are new players. They got a big order. They are also very, very happy. Okay, but Reliance Fresh, no, sir, currently, sir, on their shelf, in their store shelf, they are storing Maggie. You know, Nestle ka on a flagship product is Maggie, right? So in their store shelf, they are storing Maggie. Okay. All right. They told, okay, excuse me. But Reliance Fresh told X Limited, now we have to store your product. In order to store your product, I have to make some alteration to my shelf. I have to construct new shelf. I don't have space at all. Already I'm selling this product called Maggie. Okay. I don't have space at all. This product is not even first of all selling. I like your product. So I think many people will buy your product. So, but in order to store your display your product, I have to bring in a lot of shelves and the shelf will cost me about 10 lakh rupees. I have to do some alterations. I have to construct some new shelf. It will cost how much? 10 lakh rupees. And you know what Reliance told? Reliance Limited told X Limited, you pay me 10 lakh rupees. Because to store your product, I have to construct one extra shelf and all that stuff. Okay. So that's the reason you pay me 10 lakh rupees. Okay. Or maybe let's take a small amount. Let's say the construct that shelf, it takes 1 lakh rupees. Okay. So Reliance Fresh told you, X Limited, you pay 10 lakh rupees. X Limited told no problem. Since the order size is quite big, X Limited told no problem, I will pay. So here X Limited, now think, this is a seller. So we're talking revenue recognition from X Limited perspective here. So 50 lakh worth of goods they will sell. That's no problem. We're not talking about that. What about this? Another payment. X Limited has to make 1 lakh rupees payment to Reliance Fresh, right? That we are calling it as consideration payable to the customer. Customer here is Reliance Fresh. So seller is paying 1 lakh rupees to the customer. So for this, what to do? Okay. So for this, there are 3 provisions. Okay. Another example. All right. First one is check if the amount paid is for distinct goods or service. By paying this 1 lakh, is X Limited getting any goods or service? First, you need to check that. So X Limited paid 1 lakh. That's all. They did not get anything in return. So by paying 1 lakh rupees, can X Limited own Reliance ka shelf? No. Reliance Fresh ka shelf belongs to Reliance only. So X will not get anything. So if you feel if the seller feels they paid 1 lakh rupees, in return they are not getting any goods or services. So if it is not for distinct goods or service, by paying 1 lakh, by paying this 1 lakh rupees, they are not getting any goods or service. In that case, no sir, how much is the revenue here? 50 lakh. X Limited will not book. Maybe I'll write it down here. If it is not for distinct goods or service, then the revenue for X Limited will not be 50 lakh. Whatever amount they have paid, that has to be reduced from revenue. So the revenue will be recognized only to the extent of 49 lakh rupees. Because they paid 1 lakh rupees, they did not get anything for this 1 lakh. So there is nothing negative. I mean, this 1 lakh rupees has to be reduced from the revenue. So that means the revenue will become, or transaction price will become 49 lakh rupees in this particular case. Okay. Second case. It is for distinct goods or service, let's say. It is for distinct goods or service. How? Sir, Reliance is already selling one product called Maggie, no? Okay, Reliance told, anyway, now we will be selling your product. This particular product, Maggie, we don't want it. Take this. You pay 1 lakh rupees and take this Maggie. We don't want it. Okay. X Limited told, no problem, give it to me. I can use this product and I can redevelop it. So X Limited told, it has some usage for me, you give it. That means X Limited here gave 1 lakh and Reliance gave what to X Limited? This product called Maggie. That means here it is what for? It is for distinct goods or service. If it is for distinct goods or service, then X Limited, no, sir, will book a revenue of 50 lakh separately, and this 1 lakh, whatever they paid, they'll book it as purchases. This 1 lakh, X Limited will treat this as they purchased Maggie product worth 1 lakh rupees. So they will treat 1 lakh as a purchases and they will treat this revenue as 50 lakh rupees. They will not adjust the revenue. So revenue for 50 lakh, 1 lakh will be shown as separate purchases. This case you will do if it is for distinct goods or service and the amount paid does not exceed fair value. And the amount paid does not exceed fair value. What does that mean? Sir, let's say the fair value of Maggie is 1 lakh rupees. The fair value of Maggie is 1 lakh rupees. How much did X Limited pay? 1 lakh. So whatever is the fair value of Maggie, that much only we have paid. So if the amount paid is for distinct goods or service and amount does not exceed fair value, then whatever amount you have paid, you will treat it as purchase. Revenue will be booked at original amount of 50 lakh, like that. So in the third case, the amount paid is for distinct goods or service only. Okay. But amount paid is for distinct goods or service and the amount paid exceeds fair value. And the amount paid exceeds fair value by, let's say, 30,000. In this case, what to do? Okay, meaning what I'm trying to say is, so let's say the worth of the Maggie is only 70,000. Worth of the Maggie is only 70,000. But how much did X Limited pay? X Limited has paid 1 lakh rupees. So fair value of this product Maggie is, same example, X Limited will give 1 lakh to Reliance Fresh. Reliance Fresh will give this product Maggie to X Limited. But the value of this Maggie is only 70,000. But how much is X Limited paying? 1 lakh. So how much extra they are paying? 30,000. Okay. In this case, what X Limited will do is they will book the revenue, but not to the extent of 50 lakh. How much excess they paid? Compared to fair value, how much X Limited paid? Fair value is only 70. X Limited paid 1 lakh. So how much in compared to fair value, how much X Limited paid? 30,000 X's. So the 30,000 they will reduce it from the revenue. So means the revenue will be booked at 49,70,000. Okay. And what is the fair value of the Maggie? 70,000. So 70,000 will be accounted as separate purchases. That is what is the 3 criteria that I have listed it out here. Okay. Once again, I'll call it out for your reference here. If the amount paid is for distinct goods or service and the amount does not exceed the fair value, then you treat it as separate purchase. Revenue, you book it separately. Whatever amount, whatever goods you are getting, you treat it as purchase separately. That's one key thing. If it is not for distinct goods or service, you paid the amount, you did not get any distinct goods or service, means whatever amount you paid, you reduce it from revenue. That is the second case. Third case, amount paid is for distinct goods or service, but the amount paid is little extra. Compared to fair value, you paid extra. So whatever extra amount you paid, that excess amount, you should reduce from revenue. That's what it is. The balance, to the extent of fair value, you book it as purchases. So this are the accounting treatment for consideration payable to customer. All right. The next one is allocating the transaction price to the performance obligation. This is the fourth step. First step, identifying the contract, identifying performance obligation, finding out the transaction price. Fourth one is allocating the transaction price to the performance obligation. This is an important step. Okay. So let's do a thing. Let's learn this with the help of question itself. Or maybe one line I'll tell, then maybe we'll take up the question. Sir, if you have, let's say there is a transaction price of 1 lakh rupees. We have 3 performance obligation. Let's say ABC. The name of that performance obligation is ABC. What you have to do is the transaction price. Contract has only one. All the 3 promises you have executed as one contract, and that one contract has only one price. The price is how much? 1 lakh. But in this contract, you have made a promise to the customer that there are 3 promises you made to the customer. That I'm calling it as ABC. If this is the case, means what you have to do is, means this transaction, fourth step, what you do is this particular transaction price should be allocated to all the performance obligation. So out of this 1 lakh, some portion will be allocated to A, some portion will be allocated to B, some portion will be allocated to C. How much? We'll see. Okay. And normally this allocation, we do it in something called standalone selling price wala ratio. In SSP ratio, this allocation of transaction price, we do it to performance obligation in standalone selling price wala ratio. Okay, what does standalone selling price mean, sir? Standalone selling price means if you sell this goods, now we have 3 promises. No? Now 3 promises you have bundled and made a contract. Now, if you sell these promises or these products separately, if you sell this product separately, okay, to the similar customer and a similar circumstance, what would have been the price? That price we call it as standalone selling price. Again, I tell you, standalone selling price means if these goods were sold separately, now you have done it as a bundle. Now it's sold as a bundle. If you didn't do bundle sale, if you sold it separately, if the goods were sold separately, these goods were sold separately to the similar customer under similar circumstance, what would be the price? That particular price only we call it as standalone selling price. Okay. And in that standalone selling price, we will do the allocation. So what if we don't sell it separately only? Every time we do bundle only, we don't sell it at all. If that is the case, means if directly observable standalone selling price is not there. Directly observable means if you sell these products separately, what is the price? That we call it as standalone or directly observable standalone selling price. Suppose you never sell on individual basis. You always sell it as a combo. In that case means you don't have directly observable SSP. In that case, you have to estimate standalone selling price. For estimation, there are a few methods. One is your adjusted market assessment approach. Market assessment approach is competitor. Obviously, you have a product means your competitor also will have a product. Look at your competitor product and take the price. Whatever the competitor is selling that price you can adopt it. That you can take it as standalone selling price of this particular product. Check Mr. A. You are selling A, no? Check if let's say another competitor, similar competitor is selling a similar product for let's say 10,000 rupees. So same 10,000 can be adopted as standalone selling price of A. That is your adjusted market assessment approach. Based on competitor action, you can decide. Or you can use cost plus margin approach. Obviously, to produce this product A, you would have incurred some cost. And every company knows, sir. Obviously, they'll have a margins. Like on product A, company feels they make a margin of 20%. So to produce a product A, take cost 8,000. The margin the company expects is 20% on these products. That means the price will become 9,600. Like that. This is your cost plus margin wala approach. Third one is residual value approach. Residual value approach is nothing but balancing figure approach. Let's say A ka here like this. Let's say if A ka standalone selling price is 50,000, directly observable or estimated or whatever. B ka standalone selling price is let's say 30,000. I mean C ka standalone selling price, you don't even bother estimating that, because why? So out of 1 lakh, if 50,000 is for A, 30,000 is for B, automatically 20,000 is for C. That is your residual approach, basically balancing figure approach. Okay. So if you have 3 performance obligation, find out the standalone selling price for the other 2. So the third one will automatically become balancing figure. That is your residual value approach. Okay, Saru. All right. So let's do a thing. Let's learn this allocation. This could be important. So let's learn this with the help of one question. Maybe this one we'll take it later. Let's take up 37. Entity A enters into a contract with the customer to sell products ABC. Okay, three performance obligations there in exchange for 10,000 rupees. So 10,000 rupees is your transaction price. Entity will satisfy performance obligation for each of the product at different points of time. Okay, entity regularly sells product A separately. So here you made a combo offer, ABC as a bundle you are selling, but they feel entity product A will sell separately, and therefore standalone selling price is directly observable. Okay, because you are selling separately, the separate price itself becomes SSP. That we call it as directly observable standalone selling price. If you don't have directly observable standalone selling price, you need to estimate. Standalone selling price of product B and C are not directly observable, so you need to estimate. Because standalone selling price of B and C are not directly observable, entity must estimate. To estimate, entity uses adjusted market assessment approach for B and cost plus margin approach for C. Okay, all these are goalie. It's okay. Whatever way they can use, that's okay. We don't need that. Yes. So in making this estimate, entity, okay, blah, 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 they only given standalone selling price, basically. Okay. By saying all this story, actually all this is drama. What I simply need is what, sir? Transaction price is 10,000. We have 3 performance obligation. This 10,000 has to be allocated among 3 products ABC. In what ratio? Standalone selling price ratio. What is standalone selling price? This. So in this ratio, I need to allocate. It will be what if I have to further bring it down? It will be 50:25:75. Or can I say 2:1:3? So in basically this is your SSP wala ratio. So 10,000 you have to allocate to ABC in this particular ratio. So how much will be this? So for A ka share, it will be 10,000 into 2/6. How much is this? 1/3. So it will be 3,333. I think they've rounded it off here to 3,300. You will get it as 3,333. So for 10,000, it will be 1/6. So 10,000 divided by 6 will be 1,667. I think they've taken it as 1,700. They've rounded it off. For C, it will be 10,000 into 3/6, half, which is 5,000. Like that. Okay. Yes, people, they have rounded it off. Okay. So that means what? I think I'll just write it over here. Product ABC. If you just check over here, product ABC, how much revenue transaction price got allocated? Total transaction price is 10,000. You allocated the transaction price to all the performance obligation in this particular ratio. So for A, it got allocated 3,333. This is 1,667. And then it is 5,000. Okay, sir. This is the transaction price you allocated. But what is their SSP? Their SSP was how much? They only given over here 5,000. Normally, the standalone selling price of A is 5,000. B ka it is estimated to be 2,500. C ka it is 7,500. Correct, sir? So the total standalone selling price, in fact, they only total, which is 15,000. Correct? Correct. The standalone selling price was 15,000. Since you gave it as bundle, normally in the bundle there will be a discount. No. So basically here they have given a discount of 5,000. So when you allocate the transaction price in SSP ratio, sir, discount will be allocated to all the products. So check over here. How much is the total discount you gave? 5,000. This 5,000 discount, you gave it to one product? No, you got allocated to all the 3. Check. 5,000 is the selling price of A, but allocation is only 3,000. You only consider 3,000. That means how much discount? 5,000 minus 333. You allocated a discount of 1,667. Here 2,500 minus 1,667 gives you 833. Here it is 2,500. If you sum it up, you're obviously going to get 5,000 rupees. So what do I point out? This actually you don't need this. What you need is only this. That is the answer. That's all. This is allocation wala rule. Okay. Here I'll show you. So that means this is what is the answer that you're looking for. You just had to allocate it. You're doing it. So why am I saying extra? For the next point. So the point here is whenever you allocate transaction price in SSP, in standalone selling price ratio, the discount will be allocated to all the products. That was the point I was trying to prove. I'll tell this once again. Whenever you allocate transaction price to the performance obligation in standalone selling price ratio, the discount will not be allocated just to one product. It will be allocated to all the 3 products. Okay, that is one. Okay, which is not right under few circumstances. Which is not right under, not this question. I'll tell you the next concept. I'm making the statement for the next concept. Which is not right for few things. What is few things we will see? Or 1 second. No, I think I'll have to take that later. Okay. 1 second, people. I'll show you. Sir, normally you allocate transaction price to performance obligation in SSP ratio. And we just now proved it to you that whenever you allocate in SSP ratio, discount will be allocated to all the products. That particular allocation rule is not good, or it is not valid under few circumstances. One, what are those few circumstances? One, when you have variable consideration. Another one is, I think here only they have given, allocating discount. When you have a discount and when you have variable consideration, sir. When you have discount and when you have variable consideration, this allocating in SSP ratio should not be followed. Why, sir? Let's do a thing. Let's learn that with the help of next question. Now here, check. Question number 38. Carefully observe this. Easy question only. Okay. Entity regularly sells product XYZ individually also. Thereby, standalone selling price is given. SSP of 3 products they've given 50, 25, 25. So the total is 1,20,000. This is one. Okay. In addition, entity regularly sells product Y and Z together for 50,000. So stop there only. Sir, X, Y, Z separately also they will sell. Separately when they sell, this is the price. Not only this, Y and Z also they sell it as a combo. When Y and Z they sell it as combo, no, they sell it for 50,000. So just stop there. What is Y ka individual price? 25. Z ka individual price 45. That means put together it should be 70. Okay, individually when you sell Y and Z, totally you will collect 70. But when you sell Y and Z, only Y and Z as a combo, if you sell, as a bundle you sell, you collect 50,000. That means when you sell Y and Z bundle, you give a discount of 20,000. Correct? Correct? You give a discount of 20,000. So keep this in mind. Going further, entity enters into a contract with the customer to sell, one contract we have entered with the customer to sell all the 3 products, XYZ, in exchange for 1 lakh rupees. In exchange for 1 lakh rupees. 1 second, people. If you sell X, Y, Z separately, totally how much you should recover? Totally you should recover 1,20,000. But right now, are you recovering 1,20,000 from the customer or only 1 lakh? Only 1 lakh. That means how much discount are you giving to the customer? 20,000. Okay, stop there only. What is your normal? This is basically your transaction price. This is your TP, right? What is your normal allocation rule? This transaction price should be allocated to all the performance obligation in their SSP ratio. So there's 1 lakh in this particular ratio I allocated. In this problem, I should not do that. Why? Sir, if you allocate transaction price in standalone selling price ratio, then the discount also will be allocated to all the 3 products. But here, watch out. What is the discount you have given? 20,000. When you sell Y and Z together, how much discount do you give? Same 20,000. That means indirectly what they're trying to say. Discount of 20,000 what you have given here, no, relates only to what, sir? Relates only to Y and Z. It is not on X ka product. Here you have given the discount only related to Y and Z, because Y and Z together, individually if you sell Y and Z, no, you will recover 70,000. But when you sell as a combo offer, you recover only 50. So on Y and Z together, you give a discount of 20,000. In this contract, though you have sold 3 products, you have given a discount of only 20,000. That means this discount 20,000 does not relate to X, Y and Z. It relates only to Y and Z. So if you allocate in standalone selling price, you will be allocating discount to X also, which is wrong, because on X you have not given discount. You have given discount only on Y and Z. So normal allocation rule, that's the reason you should not do whenever you see a discount aspect. Is that okay? That's what is the point over here. Done, Asaru? Okay. Now in this case, what we have to do, sir? It's a very simple activity. I will directly look at the solution. In first case, totally how much did you collect? You collected 1 lakh rupees from the customer. On X, have you given any discount? No. I'll just say allocation of transaction price. I'll write here allocation of transaction price to X. No, sir. Directly you will allocate. How much is the X ka selling price? Standard selling price 50,000. Have you given any discount in this? No. That means to X directly you will allocate 50,000. For Y and Z put together, you will allocate 50,000, because normally when you sell Y and Z together, you sell it for 50,000. So you will allocate it like this. So total will be 1 lakh. Okay, sir. That's all it is. So how much among Y and Z separately? You need not do that separately, because they told in the contract. Check. Entity will satisfy performance obligation for each of the product different points in time, and product to Y and Z at same point of time. Product to Y ka performance obligation and product Z ka performance obligation will be satisfied at same time. Sir, you recognize revenue when performance obligation is satisfied. Since Y and Z ka performance obligation is satisfied at same time, you don't have to split it, right? Because anyway, both ka revenue will recognize on the same day. That's the reason. Even if you want the split up, we can do it. So if you want the split up, X ka you already know, which is 50,000, right? Then Y and Z, no, sir, together you have to allocate 50,000. Now this 50,000, no, if Y ka and Z ka split up, this 50,000 this 50,000 will be allocated among Y and Z in their standalone selling price. What is their standalone selling price? 25,000 and 45,000. So this 50,000 you will allocate in 25,000 is to 45,000 wala ratio. So what will be Y ka share? 50,000 into, if you add these two, I think it is 70, right? So into 25,000 divided by 70,000. So how much it will be? 25 divided by 70 into 50,000. That will be 17,857. You will give it to Y. Like that. Similarly, what will be allocated to Z? The balance. 50,000 minus 70,857, it will be 32,143. Like this you will do the split up. So X ka it will be 50, Y ka it will be 17,000, Z ka it will be 32,000. If you add these two, obviously you will get 50,000. Since both ka performance obligation is satisfied at the same time, no need to do the split up. Even if you want to do the split up, simply that 50,000 you distribute in their standalone selling price. Y and Z ka standalone selling price, which is 25 and 45 given in the question. Like that. That's what they've stopped the solution here. Okay, Saru. In fact, that also they've given here. Check. If you want to allocate, you will allocate it there like this. For Y, you will allocate 1787. If they had mentioned, by chance, actually this working is also necessary. If in the problem, if they say performance obligation of Y and Z are satisfied at different times, then you need to give this breakup. Because, sir, revenue will recognize when performance obligation is satisfied. If performance obligation of Y is satisfied today means, on Y ka revenue you can recognize today only. If performance obligation of Z is satisfied tomorrow, after 1 month means, Z ka revenue recognition happens only after 1 month. That's the reason. So if they say performance obligation is satisfied at different points of time, then you need to compulsorily split it up. Okay. But in this problem, they told it is satisfied at the same time. So split up was really not necessary. This was your case A. Okay. What about case B? I think they have given 3 cases. Let's understand this here. The entity enters into a contract with the customer to sell products X, Y, Z, described in case A. The contract also includes a promise to transfer product alpha. That means 4 products. A, B, X, Y, Z and alpha. 4 products based on transferring. Total consideration is 1,30,000. Different cases, okay? Alright. So we're charging 1,30,000. Fine, fair enough. I think we already know this. X, Y, Z. And we also have alpha. So total transaction price is 1,30,000. Done, sir. The standalone selling price of product alpha is highly variable because the entity sells product alpha to different customers for a broad range of amounts. So alpha is very dynamic product. Okay. If we find a bakra, we will sell it at very high amount. If we don't find a bakra, then we will become bakra and sell it at a very low amount. That's the reason the selling price range of this product alpha is very high, they're seeing. Okay. From 15,000 to 45,000 at any price we may sell. The range is quite high. So it totally depends on bakra scenario. So determine the standalone selling price of XYZ using residual approach. XYZ ka allocation they're asking, and alpha ka they're saying using residual approach. So alpha does not have because the range is quite high now. They're saying use residual approach. So how does residual approach work? Simple. Now, sir, it's the same as previous example, right? So X ka, have you given any discount on products X? No, it is 50,000 only. Y and Z put together it is 15,000, or even if you want to split up, we have the split up, which is, or can I simply call it as Y and Z put together 50,000? Is that okay? That means out of 1,30,000, 1 lakh relates to X, Y, Z. Balance 30,000 relates to alpha. Balance 30,000 you will give it to alpha. This is what is your residual approach. Residual approach means other products ka allocation first you do. Okay. Then this alpha ka product ka allocation, you get it as balancing figure. So this 30,000, I've got it simply as a balancing figure. This is your residual approach, like this. And moreover, when you get residual approach, always you need to check whether this amount what you have allocated is within the selling price range. What is alpha ka range? 15 to 45. Does this 30,000 fall within the range? Yes, it is within the range. So that means we don't have to do anything further. Okay. This is the allocation. You'll recognize, we just allocated now. So you'll recognize the revenue when performance obligation is satisfied, like that. Okay. Then case number C. The same facts in case number B apply, except case C mein transaction price is 1,05,000. So in this case they're saying 1,05,000. Don't assume transaction price is 130. Instead of 130, make it as 1,05,000. If this is 1,05,000 means what will happen is what they're asking. Sir, if it is 1,05,000, that means it will lead to a whole lot of drama. This is your case B. If it is 1,05,000, normally you have allocated X 10,000. For Y and Z put together, you have allocated 50,000. So the total transaction price they are saying is 1,05,000. In 1,05,000, 1 lakh is already allocated to these 3. That means 5,000 only you will allocate it to alpha. Correct? No. So 5,000 you have allocated to alpha. But check the range. Alpha ka selling range is 15 to 45. But you have allocated only 5. That means is this acceptable? No, this is not acceptable. So you need to rework. They've not given the data. So here you can only give theory. So this particular, you'll write this and they say this particular allocation rule is not acceptable because you are allocating only 5,000 to alpha, which is out of its selling price range. Hence, company has to estimate the standalone selling price using other methods and do the allocation once again. Okay, so this is not acceptable. You have to find another method and do the allocation process. That's all you need to say. You don't have facts of the case here, so we can't solve this, but we can only give theoretical answer. That's what they've given it over here. Okay, sir. All right. So again, just coming back, one more point. What is that point? Normally, transaction price is allocated to performance obligation in standalone selling price wala ratio. But whenever you have discount, you can't allocate the transaction price to performance obligation in SSP ratio, because only on some products you might have given discount, some products you may not given. That's the reason. But if you allocate blindly on SSP ratio, then discount will be allocated to all the products, which is incorrect. That is one. And whenever you have variable consideration also, whenever there is a variable consideration, like construction contract, my bonus example I give you, whenever you have bonus variable consideration, even in that case, you can't allocate the transaction price to performance obligation in SSP ratio. So why, sir? So maybe I'll just take this small example here. Just check. So let's say there is a construction, there is a contract. There is a contract to construct a building. Okay, let's say this is about, okay, let's say 3 crores. We have a contract to construct the building for 3 crores. After that, we also have a building maintenance contracts. We'll not only construct the building, we'll also maintain the building. So building maintenance contract, we have got it. For that, we have received 50 lakh rupees. Okay. Or maybe let's say smaller amount, because this only is small. Let's say 20 lakh rupees. Okay. So two promises are there over here. One, we will construct the building, and after construction, we'll also give a maintenance service, let's say for 1 year or something after construction. That's a contract. Okay. All right. So that means the transaction price looks like 3.2 crores as per this. Now, sir, in this contract, there is one more clause which says, now let's say we have this, the contract term is here is 3 years. We take about 3 years to construct this building. Let's assume. Okay. Now there is also a bonus element, meaning you will get an extra bonus of, let's say, 30 lakh, provided you complete the construction within 30 months. Within about 2.5 years, if you construct the building, then you will get 30 lakh bonus. This bonus is what? It's a variable consideration, because only if you construct the building within 30 months, you will get it. Otherwise, you will not get it. So that's the reason it's varying. It's not fixed. It depends on some other else. Hence, we call it as variable consideration. Okay. Now, let's say organization feels we are experts. We have a lot of expertise in this particular construction area. Aram se we can complete it within 30 months. We are very, very sure that we will construct it. So what does the standard says? You can add variable consideration to the transaction price, provided organization is reasonably sure that significant reversal of revenue will not happen in future. Organization feels reversal will not happen, we will get it. That means what will be this? You will add bonus variable consideration. So the transaction price became 3.5 crores. Okay, sir. Now this 3.5 crores should be allocated both to building and maintenance contractor. Do you think that would be right? Wrong. Why? Sir, if you allocate 3.5 crores to building and maintenance allocation will not be 20 lakh. It will be something else, because this 3.5 crores includes bonus also. No? So bonus also will get allocated to maintenance contract. Yes, because if you allocate it, obviously if you do the math, it will be what, sir? In 3:2 ratio. Here it is actually 30:2 ratio. If you allocate it, if you do the math over here, 350 lakhs divided by 32 into 2, if you do, this will not be 20 lakh. It will become, this will become, if you do the allocation. So basically I've done 3.5 crores allocation. I'll show you how you got it also, just to be sure. So normally transaction price you allocated in standalone selling price. What is the standalone selling price? 3 crore is to 20 lakh. That is nothing but 30:2 if I bring it in fine tune number. So maintenance if you allocated. So 3.5 crores. 1 second. 3.5 crores into 2 divided by 32. If you do, my calculator is showing 21.875. Actually maintenance contract is only for 20. But when you do this allocation, you're getting 21. Why? Sir, even some portion of bonus also got allocated to maintenance contract. Now you tell me, sir, is bonus any which way related to maintenance contract? No. This bonus variable consideration was only associated with building the construction, right? But if you allocate this, if you do normal allocation process, the bonus will get allocated to maintenance contract wala performance obligation also, which is wrong, because bonus is no way related to this maintenance contract. Hence, what you have to do here is you have to transfer entire 30 lakh to this building construction only. So to this building, you will allocate 3.3 crore. For the maintenance, it is 0.2 crores. So that will be your allocation price. Transaction price is 3.5 crores. You can't do your normal allocation here, because this bonus of variable consideration does not relate to both. It only relates to one in that series. So that's the reason normal allocation rules should not be done in case of discount as well as in case of variable consideration. Okay. That is what I've written in there. Okay, so all that I've written it here, so I'll not go through further there. Okay, the last step number 5. Sir, you will recognize the revenue when performance obligation is satisfied. Okay. When can you say performance obligation is satisfied? When you have transferred the control of goods or service to the customer. When the goods or service control you have transferred, we say, or when the goods are, when you have made the transfer of goods or service, when you have transferred the goods or service to the customer, we say performance obligation is satisfied. So when can you say transfer has been made? You can say goods has been transferred when the customer gets the control. You can say customer has the, when you can say transfer of the goods is complete when customer gets control. So when can you say control has been transferred? For that, we have certain criteria for which, for our class purpose, we used to call it as PPL raw, not IPL raw, IPL season, no? Yeah, you can call it as PPL raw. So what is this? If these factors are there, means you could say customer, the transfer of control has happened. So what is this P? P is customer has a possession of the goods. Another P for entity has a right to collect the payment. L, customer has legal title. R, the customer has risk and reward. A, customer has accepted the product. If these are there, means if these indicators are there, means then we say the transfer or the customer has control over the goods or service. So performance obligation has been satisfied, like this. Okay, if theory questions comes, you may have to write this. Otherwise, not required. Okay. All right. Another one is a fancy diagram like this. Sir, revenue recognition ka simple rule is what, sir? Recognize the revenue when performance obligation is satisfied. Now, just take a small example here. Let's say we have a construction contract. Let's say we have a construction contract, and this construction contract, let's say we'll go for, we're constructing a building. Okay. And this building or construction, let's say we'll take for 3 years. We'll go on for 3 years. Now we are architect. Okay. We are architect. We are we're constructing a building for one of our customer, one of our clients. And this construction time is about 3 years. That means performance obligation will get fully satisfied only after 3 years. And the architect, my obligation or my duty is to construct this building. And this building will be fully constructed only after 3 years. That means, literally, if you interpret the standard, what is the revenue recognition standard says? Recognize the revenue when performance obligation is satisfied. Here, performance obligation is getting satisfied after 3 years. That means what, sir? First year, second year, architect company should not book any revenue. Third year, let's say this contract is for 10 crore. Okay. First year, 0 revenue. Second year, 0 revenue. Third year, bumper revenue of 10 crore rupees. Is that right? Sir, first year mein company has obviously they're constructing the building, means they'll have to incur some cost. So first year cost you will book any which way. Let's say they booked the cost of let's say 50 lakhs. Second year, let's say they booked the cost of let's say 3 crore. Third year mein, let's say they booked the cost of let's say 2 crore or another 4 crores. That means the total cost they booked is how much, sir? 7.5 crores. First year mein, if you literally interpret the standard, any revenue you're booking, no, 0. Third year, second year, no. Third year bumper revenue 10 crore. So if you do this accounting, how the financial statement of this particular contractor will look like? First year cost is 50 lakh, no revenue. That means first year it's a case of profit or it's a loss. It's a case of loss, 50 lakh loss. Second year bumper loss of 3 crore. Third year bumper profit of 6 crore. Does that sound logical to you? No. That means what, sir? They had to bring in a little more criteria about this performance obligation. When does this performance obligation get satisfied? It is not that if you're after 3 years only it will get completed. No. When does performance obligation get satisfied? This is the control diagram. Okay. So performance obligation can be satisfied at a point in time or over a period of time. We can say performance obligation or control has been satisfied at a point in time or over a period of time. At a point in time means it's like in your costing journal you have studied, no? Or in your AS7 also you have studied. Completed contract method, percentage completion method. So if you say performance obligation or control is transferred at a point in time, then you will account it like completed contract method. Only after the contract is fully completed, you will recognize the revenue. However, if you say control is satisfied over a period of time, then you will do the accounting on a percentage of completion basis. Meaning if 10% of the work is complete, 10% of the revenue you can recognize in this year. Next year, if let's say 40% of the revenue is completed, means 40% of the revenue you can recognize like that. Okay. For that, when can you say control is transferred at a point in time? When can you say control is transferred over a period of time? For that, they have given certain conditions, which only are represented as like a flow chart here. First check, does the customer control the asset as and when it is created? Does customer control the asset as and when it is created? If the answer to that is yes, directly you can conclude control is satisfied over a period of time, meaning you will go for percentage of completion accounting. So what is that, sir? Sir, for construction contracts, this criteria will be satisfied. For construction contract, this criteria will be satisfied. What is that criteria? Does customer control the asset as and when it is created? Let's say, sir, building is for 4 floors. Okay. for floor number 1, floor number 2, floor number 3, and floor 4 floors ka building construction activity it is. Okay, that's our job. We as an architect have to construct a 4-story building. Okay, now if you think, let's say first floor of the building is already completed. The floor number 1 is already completed. Now, suppose we cancel the contract. We had some misunderstanding. One floor got constructed. After that, we had some misunderstanding and we canceled the contract. Now, do you think what the customer will do? He will demolish this first floor and redo it? No. He will appoint another architect. Another architect will start working on floor number 2 onwards because floor number 1 is already constructed. That is what this criteria is saying. Does customer control the asset as and when it is created? If first floor is constructed, means the customer can control that first floor. That's the reason. If that answer to that is yes, means we say is transferred over a period of time, meaning you can go for percentage completion method. In all your construction contracts, customer controls the asset as and when it is created. So you always go for percentage completion method. So meaning you will not wait for 3 years to book the revenue. So first year you check how much percentage of work is completed and accordingly go on booking the revenue. If 5% of the work is completed in the first year, 5% of the revenue you can book like that. Okay. So this accounting is not followed practically is what I'm trying to say. Okay. Alright, if the answer to the first case is no, if all like this, they've given various criteria. Okay, if the first criteria fails, then just check, does customer receive and consume the benefits as and when the entity performs? Does customer receive and consume the benefit as and when the entity performs? Let's look at a small example, like internal audit. Okay, or let's say monthly payroll services. We are one company, we are giving some payroll service to one of our client. The contract is for 1 year. 1 year we will give monthly payroll service to the client. Okay, based every month ka payroll calculation we will do. Based on our calculation, the company will give the salary to their employees. Okay, now think logically, sir. Does customer receive and consume the benefit as and when the entity performs? Let's say 1 month first month I already completed my payroll wala calculation. So based on my calculation, a company release the salary to the employees. Okay, that means what? As and when I'm performing the work, is the entity getting benefited? Yes. If 1 month, if I do my payroll calculation, 1 month ka benefit entity already gets, the customer already gets. If 2 months ka, if I've given payroll services, means they would have released the salary to their employees based on that calculation. So that means they've already received the benefit. So does customer receive and consume the benefit as and when the entity performs? Yes. As in every month I give my payroll services, customer will go on getting benefited. Okay, this is the same case with case of internal audit. Suppose you have been appointed an internal audit of a bank, right? Normally in case of internal audit, what do? After every month we give a report. Once we give the report, client will get benefited from it. Yes or no? So as and when I go on, if let's say April month I did internal audit, and if I give the report to the bank people will get benefited from it. Yes. Whatever is a mistake that we've identified, they'll try to correct it. Yes. So as and when the entity performs the work, customer will get benefited. So if the answer to that is yes, then again control is satisfied over a period of time. That means if I'm an auditor, if I have an internal audit engagement for 1 year, I don't have to wait for 1 year to book the revenue. If 1 month first month if I've already done the audit and if I've already given the report, then 1 month ka revenue I can already book. Same goes for monthly payroll servicing. The contract may say term is 1 year. After 1 month, if I've done my calculation, if I've given my payroll report, I mean 1 month ka revenue, I can go ahead and book it. I don't have to wait till 1 year. That is the case. Okay. If the answer to this is no, so when can it become low? Look at it like a statutory audit. Statutory audit also, like, so does the customer receive and consume the benefit as and when the entity performs? Like I'm doing a statutory audit. I go and sit in my client premises and I'm doing the audit. Will the client get benefited? No. Client will get the benefit only when I issue the audit report. When I issue the final audit report, only then it will be beneficial for him. Yes or no? As and when I'm working, in fact, he will think of me as a pain. Correct? No. Because we'll ask 101 questions. Yes. So the customer does not receive and consume the benefit as and when I perform in case of a statutory audit. So the answer to this is no. So if the answer to this is no, check, does the entity have alternate use of the asset? Do we have any alternate use? Sir, we are an auditor of Wipro. Okay. Let's say we did Wipro ka vouching. Contract got cancelled. We are also auditor of Infosys. Wipro ka auditing or vouching, can we apply to or Wipro ka audit report? Can I attach it with the Infosys? Yeah. Copy paste, change the name and issue it? No, right? So that means, do we have, as an auditor, for audit report, do we have alternate use? No, audit report is relevant for only that company, right? So you need to check, does entity have alternate use to the asset? Okay. So if the answer to this is no, in the case of audit report, obviously, definitely we will not have alternate use, because one company audit report will suit that company only. You can't change the name and give it to another company. Ideally, it will not. Practically, it is done or not. It's a different issue. I'll not go there. Okay. But it doesn't serve the purpose. Okay. So does our entity have alternate use? No. Does entity have a right to collect the payment? Payment here includes what, sir? Including margin also. So you don't have alternate use to the asset, but at least you have a right to collect the payment. If you say, yes, I do have as an entity or as an entity, I have a right to, I don't have alternate use, but I have a right to collect the payment work. Let's say I'm doing a statutory audit for one company. Okay. So there are some issues going on. Let's say in between May, we cancel the assignment. I've already spent some work. That means, will I let go of it or I will collect some money? Obviously, my contract will say, if the engagement gets cancelled midway, let's say my contract says that I will have a right to collect the money. Okay, for whatever hours I've spent plus with my margin, I'll be able to collect whatever cost I've spent. Let's say I've spent a cost of 1 lakh rupees. I'll not recover just 1 lakh. I'll include my margin also. Let's say my margin is 30%. So 1 lakh plus 30%, which is 1,30,000. If such a clause is there in my contract, saying if the contract is cancelled midway, I have a right to collect the payment with margins. So if you have a right to collect the payment, then automatically you say control is satisfied over a period of time. Meaning you do again percentage of completion method like that. If you say, no, sir, you don't have a right to collect the payment, then we say control is satisfied at a point in time. At a point in time means you can't recognize the revenue now. Only when the performance obligation is fully satisfied, only then you can recognize the revenue. Like if you want to take the example of normal calculator dealer. Let's say, sir, A Limited is a calculator dealer. They made a contract with B Limited to sell 1,000 calculators. Okay. Now you would tell me, sir, if this particular contract gets cancelled, will A Limited really worry? No, because calculator is something, Aram say, if B Limited doesn't want the calculator, A Limited can sell it to another entity, Z Limited, B Limited, C Limited, whatever. That means what, sir? In case of this particular goods, does entity have alternate use? Absolutely yes. If this calculator, if B Limited does not want it, A can sell it to some other party. So that means A Limited does have an alternate use. So if the answer is yes, the entity does have an alternate use to the asset, then you control, we say, is transferred at a point in time only. So in this particular case, sir, A cannot recognize the revenue on the contract date. Only when A has performed this performance obligation fully. What is this performance obligation? To deliver the calculator. Once A Limited has given this 1,000 calculator to B Limited, only then his performance obligation is satisfied. Only then he can recognize the revenue. Okay, because A has alternate use of the asset. That is the reason. So just to sum up, simple, they've given few parameters. Okay, so what are the parameters again? Does the customer control the asset as and when it is created? This is true in case of construction contract. If the answer to that is yes, you will say control is transferred over a period of time. If it is over a period of time, you will go for percentage completion method. Then if the answer to the first criteria is no, then check the second criteria. Does customer receive and consume the benefit as and when the entity performs? As and when the entity performs this work, is it beneficial for the customer? If the answer to that is yes, then again we say control is satisfied over a period of time. Then if the answer to that is no, check whether the customer, does the entity have an alternate use to the asset? If the answer to this is no, meaning we don't have alternate use, at least check, do you have a right does the entity have a right to collect the payment for the work done along with reasonable margins? Okay. If you say yes, we do have a right to collect the payment, then again control is satisfied over a period of time. If you have, or if you don't have right to collect the payment, then control is satisfied at a point in time. Or if you say no, we do have an alternate use to the asset. If contract gets cancelled, we can sell this goods to somebody else. Okay. So if entity has an alternate use to the asset, the answer to that is yes, then control is satisfied at a point in time. If you say control is satisfied at a point in time, then you will recognize the revenue only when the performance obligation is fully satisfied, like completed contract method. If the control is satisfied over a period of time, then you will apply percentage of completion method. Okay. So that's all is control diagram all. Okay. Okay. The next one is bill and hold arrangement. Go through all of this. These are quite specific. 1 or 2 times if you do it, obviously you will remember it. I'm not saying all this will come, but straight away theory questions will not come. But all this can get applied as a MCQ question or case study based question. Quite easy to apply all this. Okay. We have solved enough cases in our class only. Based on this only, I think we have solved 7-8 cases in our class. Now I don't have so much time, so I'll skip ahead. But based on this only, if you know this properly, all those case studies you can do. That's the reason I've taken this example, just to prove a point. I didn't have time, so that's the reason this particular numbers like this. Okay, bill and hold arrangement. In bill and hold arrangement, what will happen is, sir, let's say one company, the seller, they've already raised the invoice amount on the customer. Okay. Let's say the money is also received. Money is anyway irrelevant. Here in revenue recognition, nowhere we give a specific about money. Money could be received now or it could be received later, whatever. All we say is consideration collection should be probable. We should have a reasonable assurance that we will collect the money. Whenever you want, you can collect the money. That becomes irrelevant in this particular case. So coming back to this example of bill and hold arrangement, what will happen is, let's say here A Limited and B Limited have have a contract. Let's say A Limited has to sell 1,000 quantity of some goods or 100 quantity of some goods to B Limited. A Limited has already raised an invoice. Let's say the value of this goods is 10 lakh rupees. A Limited has already raised the invoice. A Limited wanted to deliver the goods. They're saying the goods are already there in A Limited premises. They want to deliver it to B Limited. But B Limited is saying, stop macha, don't give it now. I'll take it after 6 months. Okay. They made the contract. A Limited is ready to deliver the goods. A Limited has that goods in his factory. He's ready to deliver. But the customer, B Limited, is saying, I will take it after 6 months. A Limited asks, why? B Limited is saying, I don't have space in my factory. I don't have space in my factory. So you keep it. I'll collect it after 6 months. A Limited said, then why are you making the contract now? B Limited is saying, I'm worried that the price of this goods will increase in future. I'm worried that the price of this goods will increase in future. Hence, I'm executing the contract now only. Okay. But I don't want to take the delivery now. Okay. I'll take it after 6 months because I don't have space in my factory. A Limited told, okay, no problem. Okay. Now the question is, when should this 10 lakh revenue be recognized? Today or after 6 months? Because if you just check, plain interpretation of IND AS 115 says what? Recognize the revenue. Obviously, these goods have alternate use. Correct. Now I can use that word. Let's say there's a normal goods. Okay. So if contract gets cancelled, then A Limited can sell this goods to somebody else. So the goods have alternate use. So if goods have alternate use means control is satisfied at a point in time. That means you can recognize the revenue only when the performance obligation is fully satisfied. And performance obligation will get satisfied only when you deliver the goods. And customer is not ready to accept delivery. He is pushing. So in this case, what to do? So for this there is a separate provision that only we're calling it as bill and hold. You've sent the bill, but you're not able to deliver the goods. You're still holding the goods. So in this case, what standard says is you can recognize the revenue of 10 lakh today itself. You can go ahead and recognize the revenue of 10 lakh today itself, provided certain conditions are satisfied. For our class purpose, we used to call this as SIPUD. SIPUD. Yeah. What is this SIPUD, sir? See, if all the SIPUD is satisfied, you can go ahead and recognize the revenue. What is that? S for the agreement to be substantive, meaning the customer should have initiated this agreement. There is a delay in delivery, no? The A Limited should have not caused the delivery delay. Who should have caused the delivery delay? Customer. Customer is requesting for delay, not A. That's what we mean by S. The agreement to be substantive, meaning it should be initiated by the customer. I for the product should be identifiable as belonging to the customer. So obviously now we have not delivered this goods means the goods is still there in our factory. But you want to recognize this as a revenue. Sir, the moment you book the revenue, is it your goods? No, that goods belongs to B Limited. That means this goods, no, you should not mix with other goods. You should keep it separately. Or you should put a tag or in a box. Somewhere you should store it in separately, saying you should be able to identify. Whenever a customer walks in, a B Limited walks in suddenly, within 6 months, someday he walks in to the factory, he should be able to clearly tell that this goods is mine. So that's what is I. This product should be identified as belonging to the customer, meaning you should not mix it with the other goods because this is not your goods. It is belonging to the customer because you already booked the revenue, right? So you should store it separately. That's what I stands for. T for the product should be ready for physical transfer. Now B told initially he wants delivery after how many months? 6 months. Later on, let's say after 4 months, he came and said, give me delivery. A Limited should be in a position to sell this goods. You should be able to in a position to deliver this goods because those goods are not A car, it is B car because you already booked the revenue today only, right? So product should be another piece. Product should be ready for physical transfer. So if customer changes in mind, if he asks the goods much sooner, A Limited should be in a position to transfer this goods. That's what is P for. The goods should be ready for physical transfer. U/D. U/for D for the entity should not use this product. Just because it is there in your factory, you should not use it because it is not yours. It is your customer's. So you should not use this product or direct this use to another customer. Meaning entity should not use this product or give up this goods to some other customer. Anyway, that customer is not accepting the product. So let me give it off to another customer. That should not happen because this is not your product. If you want to book it as revenue means you should not do this. You should not use the product or direct its use or give this product to another customer. So if all this is satisfied or the day all this will be satisfied, that day you can go ahead and book the revenue. If today only, if this SIPUD is satisfied, today only you can go ahead and book the revenue even though your performance obligation is not satisfied, a specific case. Okay. That's about bill and hold. And one more thing you need to keep in mind is here, sir, there are not one performance obligation. Here there are two performance obligations hidden. What? Why? Sir, one performance obligation is to transfer goods. Goods is one performance obligation. But are you transferring only goods or are you also storing the goods? You're storing the goods for 6 months in your factory, right? So even the custodial service is a separate performance obligation, hidden one. Okay. So obviously, sir, if you're storing the goods for 6 months means you will not sell it for 10 lakh, right? Maybe instead of 10 lakh, you would have sold it for 11 lakh rupees, correct? Normally, only for goods sale, you may charge 10 lakh. But now the customer is asking us to store the goods for 6 months. That means we may charge a little more or we may not charge it. That's a different issue. Charging or not charging is irrelevant over here. Okay. So even custodial service that you are giving, no sir, represents a separate performance obligation. So if it's a separate here custodial service, I'll write it as CS. This is a second performance obligation. So if the transaction price is 10 lakh, this 10 lakh has to be allocated to goods also. It has to be allocated, some portion has to be allocated to custodial service also. Goods ka revenue recognition, you can do it today only provided that SIPO is satisfied. Custodial service ka revenue recognition, you have to wait. You can't recognize it immediately because you're giving custodial service for how many months? 6 months. So as in month, if 1 month is over, 1 month ka custodial revenue you can recognize. 2 months is over, 2 months ka custodial service you can recognize, like that. So you'll have as and when the month passes, you can go on recognizing custodial service ka revenue. Till then you have to wait because this is also a separate performance obligation. We have solved a question on this, so that I'll just quickly remind you on that. So do not forget that will be a hidden adjustment in these sort of questions. Okay, the next one is repurchase agreements. May not be that important, so quickly I'll tell. Repurchase agreement means first you will sell and then you will repurchase. It's like a sale and lease back. Okay. So this repurchase agreements can come in 3 forms: forward, call, and put. This is not your SFM forward, call, put. Okay, forward means the entity has an obligation to purchase. They have an obligation to purchase it. They cannot escape from it. They have to buy it back. First they sell and then they'll buy it back. Call, if call means they use the word call. So if there is a call, if this repurchase agreement has repurchase arrangements has come in the form of call, means the entity has a right to purchase. They only have a right. If they want, they'll exercise this right, or if they want, they'll let this right get lapsed. That is entity ka choice. So first case mein entity does not have choice. Second case mein entity has a right, meaning they have a choice. If they want, they'll buy back, or if they want, they'll not buy back. Last one is put. Put means entity has an obligation to purchase, but only at customer's request. Put means if customer wants to sell the product back to you, then entity has to buy. We don't have any other option, like that. So this repurchase agreement can come in these 3 formats: forward, call, put. Forward may entity has a right, entity has an obligation to repurchase. Call may entity has a right to repurchase. If they want, they'll buy, or if they want, they'll not buy. However, in put may entity has an obligation, but at customer's request. Only if customer wants to sell back, then only entity has to buy back. Otherwise, not required. So in case of forward and call, sir, check if the repurchase price is greater than original selling price. You think logically, sir. You sold the goods for 10 lakh. That is your original selling price, which I am calling it as OP. You are repurchasing. Repurchase price, we call it as RP. You are repurchasing for 13 lakh rupees. First, you will sell for 10 lakh, and then you are repurchasing for 13 lakh. You'll sell it now. Okay, you'll sell and recover the money now. You'll repurchase, let's say, after 2 years. That means what? Is this really sale? No, obviously it's a finance arrangement. You're selling for 10 lakh and recovering 10 lakh now. You're repurchasing means you will pay back. When will you repay? Not now, after 2 years. How much? 3 lakh rupees. So if the repurchase price is greater than selling price, it is not really a sale. It's a finance arrangement. Indirectly, you wanted money. You're using goods as a tool to raise money. So don't account revenue and all. Treat it as a finance arrangement. This is not really a sale at all. Okay, you're using goods as a tool to raise money. That's the reason you're doing all this harkate. Okay, extra affair you're doing because of this. If it's other way around, if repurchase price is lesser than original price, let's say originally we sold for 8 lakh, we'll repurchase it, let's say only for 5 lakh, but we'll repurchase it only after 2 years. Then do you think any customer will, or let's say we'll repurchase it after 1 year, let's say. Okay, let's say we'll repurchase it for 7 lakh rupees. Okay. Now, why will the seller agree for this? Why will the buyer agree for this? Sir, it's a simple thing. Okay. 1 year you're using this. First of all, you're selling the product now. Its value is 8 lakh. That's the reason you sold it for 8 lakh. After 1 year, if you're buying back, means 1 year the product has already been used. If the product is already used, means do you think its worth will be 8 lakh? Obviously, its worth will be less. Correct? No. That means in this case, again, it is not sale. It is a leasing arrangement. It's a lease arrangement. The product, basically, the other party, he wants to use the product for 1 year. He doesn't want the product in totality. Okay. He just wants the usage right of the product for 1 year. That's the reason you're doing all this arrangement. So in this case also, it will be a case of a lease. So it's not really a sale, it's a leasing arrangement. So account it like that. Okay. So don't bring in your IND AS 115 drama over here. However, if it's a put option, this is for forward and call. If it's a put option, just check. RP is your repurchase price, MP is your market price, and OP is your original selling price. If RP is greater than OP, check in this case. I think we can understand this with the help of numbers better. So originally you sold it for 8 lakh, you're repurchasing for 10 lakh, but the market value of that product is only 9 lakh. Think logically, sir. You have sold it for 8 lakh now. Market value of the product on the date you are repurchasing it, market value is only 9 lakh, but you're repurchasing it for 10 lakh means this is clearly a finance arrangement. Okay. What you are paying over and above the market price. That means what? you're paying extra means this is a loan. On loan, obviously, you will pay interest as an extra component. Yes or no? That means if this is the case, means that's what we equate in the equation. If RP is greater than equal to OP, okay, again, I told you how to construct this equation also, right? First, write RP, OP, RP, NP 3 times. Greater than equal to, lesser than equal to. Construct this equation. Then this is greater than, this is lesser than equal to, and this is ulta. Like that, you can remember this. Not popularly asked, but you can reconstruct it. So if this is the case, means it becomes finance arrangement. Second case, RP is greater than OP, but RP is lesser than MP. So you sold originally for 8 lakh, you're repurchasing it for 10 lakh. So RP is greater than OP. But the market price of this is only 12 lakh. Market price is actually 12 lakh. Now you tell me, well, seller, sir, put option means entity has an obligation only if the buyer wants to sell. Only if buyer says I want to sell, then only entity has an obligation to repurchase. Think logically, the market the value of that product is 12 lakh. But you have made a repurchase arrangement that you will buy it at 10 lakh. Will he sell on? The worth of the goods is 12 lakh, sir. Okay. You have made an arrangement that you will buy it for 10 lakh rupees. Will that particular party exercise this option? Obviously, he will not exercise because worth is 12. Why will he sell it for 10 lakh rupees? So that means there is no economic incentive to sell it. That means you will consider this as what? He has a right to sell, no? So you will treat it this as a sale with a right to return. You know the provision of sale with right to return, no? So treat it like that. Because there is no economic incentive to return. Worth of the goods is 12. Why will he return it? Why will he sell it for 10 lakh rupees? So there is no incentive. So you'll simply treat it as sale with a right to return. However, if RP is lesser than OP, but RP is greater than MP, originally you sold it for 12 lakh rupees, you are repurchasing for 10 lakh. But the market value of that product is only 9. So compared to market value, you are buying it at a higher price. So the economic incentive is there. But still, he's getting lesser than what he is getting. So in this case, it will be treated as a lease arrangement. Okay. So just go through this. I'm not seeing too many questions, but if in case comes, yeah, I think you can manage. All right. The next one is contract cost. Contract cost. Normally, to execute contract costs are broadly classified into contract acquisition cost, contract fulfillment cost. Contract acquisition cost means to acquire the contract, you will incur certain cost, like salesman's commission. Contract means there will be 2 or more parties. No? So those 2 parties could be unknown. So broker can help these 2 parties meet up and execute the contract. So broker, because he is helping the parties to meet up and execute the contract, he may charge some commission. So that brokerage, the salesman's commission or brokerage commission and all becomes your contract acquisition cost. Okay. So what should we do for this contract acquisition cost? So IND AS 115 says, if this contract acquisition cost, if it's an incremental cost means those costs which come only due to contract. If contract is there, this cost also will be there. If contract is not there, then this cost also will not be there. That's what we mean by incremental. Only because of this contract, this cost has come. That's the true with case of brokerage. Yes, sir. Only because you have signed a contract, you are paying brokerage to the broker, like that. So if you say if it is an incremental cost, and if you feel that you will recover that cost, because obviously these are all, obviously, sir, we are talking about contract cost. To execute the contract also, you will incur some cost. Like if it's a construction contract, first you have to build that building. No? To construct that building, you will incur some cost. Later on, you will recover money from your customer. So that's your contract revenue. So if this cost is an incremental cost, and if it is expected to be recovered, if the entity feels they will recover this, then you can recognize this as an asset to the extent of recoverability. Okay, let's say you have incurred 1 lakh, but you feel you can only recover 80,000 because you made a contract like that. Okay, you have spent 1 lakh rupees, but you feel you can only recover 80,000. That means you can show this 80 as an asset, but only to the extent of recoverability, which in this case is 80,000, like that. So these sort of assets, contract cost also can be recorded as an asset, because these sort of contracts, right, don't get, like especially construction contracts, they don't get fulfilled today only. They get fulfilled over 3 years, 4 years and all that. So all this cost, you can recognize it as an asset. And then you'll have to amortize this. If contract term is 3 years, all this will be amortized over 3 years or depreciated over 3 years, like that. So suppose contract term is only 1 year, means then the entire cost will be transferred off to P&L in 1 year itself, like that. And then you could have some contract fulfillment cost also. Contract fulfillment cost means to, name itself is saying, contract fulfillment cost. To execute the contract, you will incur some cost. Like to construct the building, you'll have to incur material cost, labor cost, etc., etc. Okay. So if you have contract fulfillment cost, first check if it is covered. If these costs are covered under other IND AS, like IND AS 2, IND AS 16, IND AS 38, 40, like this. If other standard talks about it, if other standard is covering this, then you account it as per other IND AS only. No need to account it as per IND AS 115. However, you feel none of the other standards is talking about it. Okay. If that is the case, means check whether it is a directly attributable, whether these costs are directly related to these costs, whether these are directly attributable cost to the contract. and see if it is expected to be recovered. Can you recover this cost? If you think yes, and these costs also enhances the asset used to satisfy the performance obligation. If these are satisfied means, then you can recognize this cost as an asset as per IND AS 115. Since other standard is not talking about it, you will book this as an asset, and this is an asset as per IND AS 115. Okay, like to give you an example, let's say you're doing a construction contract, you have a bulldozer. So bulldozer is a property, plant and equipment. IND AS 16 talks about it. Okay, let's say that that bulldozer, no, sir, had one scoop. Normally to pick up the dirt, you have that scoop kind of a thing, bucket kind of a thing. No, it had only one. But this is a big contract. You feel a lot of materials that is being dumped, which you need to pick it up. So one scoop is not sufficient, so you attached another scoop. One bucket is not sufficient, you attached another scoop for it, so that you can pick up the things faster, pick up the material faster and throw it to the other place. Okay. Now, bulldozer is already functioning the way it has to. That means it has already reached that management ready stage. So that means this extra scoop, whatever you have added, IND AS 16 does not talk about it. So that means what, sir? You have to check whether these costs are related to this contract. Yes, obviously, you have attached this scoop so that you can execute this contract. So it is directly attributable. You need to check, can you recover this cost? Yes, you can. Let's assume that you can recover the cost. Then does it enhance the assets used to satisfy performance obligation? Yes. Earlier I used to pick only little quantity of the dust. Now I'm able to pick up a lot more. So obviously it is enhancing the asset capacity. So if all the three are satisfied, then you can record all this cost. You can record it as an asset. But this asset will be as per IND AS 115, not as per the other assets. Okay, like that. And this asset recorded will be amortized over the contract term, like that. However, if the amortization period of the asset is the contract term itself is less than 1 year, then the entire contract asset will be amortized to P&L within 1 year itself. No point even recognizing contract asset. Entire cost will go off to P&L only if the term is less than 1 year. Okay, sir. Next is service concession contracts. So how much more, sir? Okay, I think this is the last concept, and we have 1 or 2 questions. That's all. Yeah. Okay, already fed up. Yeah, these are standards which has a lot of concepts, small concepts. Okay, service concession agreements, service concession arrangements. So what is the service concession arrangement? It is a private company building infrastructure for public use. This we call it as public-private partnership. PPP, public-private partnership. Or we also call it as BOT, build, operate, transfer. So what is this? It's simple. This practically happens also. Let's say government has a project to construct a highway, a good quality highway of, let's say, a 20-kilometer stretch. They want a good quality roads. Highway they are revamping. Okay, they want to lay down, they want to make 4-lane highway for 20-kilometer stretch. Okay. Now government does every work, they can't do it by themselves. Okay. So what they've done is they've outsourced this work to a private company. So there is one private company, what they'll do is they will construct this highway 20 kilometers. Okay. And they'll also construct one toll collection booth. Toll booth. Okay. Obviously, if you use the highway, you all obviously know that to use the highway, the government will put chunas for us. Yes. So one toll collection is there, where now it's a fast tag or this tag or that tag is there, automatically money gets deducted. See, earlier we used to pay in cash, now everything is digital. Okay. So like that. So this particular private company, sir, they are constructing this particular highway. Okay. For themselves, no, for the government. So that is what we mean by private company building infrastructure for public use. So like this, if you are constructing highways, etc., what to do? So that is your service concession agreement. Now we are talking from private company ka perspective. So obviously they will not construct this highway and all at free of cost. It's their main business. So that's a revenue for them. So how should we recognize the revenue? So first you need to check. Obviously we know that the private company will not construct or will not undertake this activity at free of cost. They will charge. So first you need to check how or what is the private company getting. So let's say government told the private company, you construct this highway and you construct this toll booth. I will give you 200 crore rupees. Not now, in 3 years time. Government releases its payment in its own way. Okay. So government will give 200 crores for constructing the highway. That means from the private company perspective, what do they have? They have a right to collect cash. That right to collect, they have a contractual right to receive cash. That means they have a right to, they will record what, sir? They will record financial asset. A contractual right to receive cash is nothing but financial asset. So if the private company has a right to collect cash from the government, they will record financial asset. And we know this financial assets initially is recorded at what value? Fair value itself. And this financial asset will be recorded at what value? I mean, using what method? Subsequently, you will measure it at ACM, FET, OCI or FETPL method. Generally, you will use ACM method. If you're using SEM method, you will book interest income. Yes, no? Correct. On the financial asset, you will book interest income, etc., etc. Like this. This is your normal accounting. Okay. Go on booking. Whenever you receive the income, finally this financial asset will, whenever you receive money from the government, the financial asset will get closed. Like that. Till you receive the money, in this case, in this present example, government told I'll pay you after 3 years. So till 3 years, you will have to record, you will have to show financial asset. Once you have received the money, financial asset will come to an end. Okay. And sometimes what happens, government will also tell, anyway, you have constructed a toll booth, no, appoint one person and collect the toll on my behalf. So if company is giving some extra service, like toll collection service and all, no, that also they have outsourced this to private company only. Then that also becomes the revenue. Obviously, we'll do this, we won't do this extra service at free of cost. We'll charge some money. So if any extra service like toll collection, if you have given, that also will be booked as a revenue. Okay. Sir, what if you have incurred any borrowing cost to construct this highway? Sir, does this highway belong to private company? Can private company show this highway as an asset in their books? No, no, no. This asset belongs to the government. Correct. So if you have incurred any borrowing cost, you cannot capitalize it. Whatever borrowing cost you have incurred, like if you have borrowed, if a private company has taken a loan to construct this highway, on the loan they will incur borrowing cost like interest, and interest cost and all will be transferred off to SPL. Because, sir, borrowing cost can be capitalized. Yes, highway is a qualifying asset. Yes, highway takes a lot of period of time to get constructed. Okay, to get ready for use. So it's a qualifying asset. But can private company show this highway in their books? No, it belongs to the government. Since there is no asset for private limited company, okay, this borrowing cost will be transferred off to P&L account in this case. Don't say we'll add it to financial asset. That financial asset is accounted as per IND AS 109, so you can't bring in all this stuff. So hence borrowing cost here will be transferred off to P&L account. That is one thing. Or second scenario, government may tell, government is selling private company, you construct the highway. I will not give you any money. You construct the highway, I will not give you any money. Then why will private limited company construct? Hang on. Okay. Government is selling private company, you construct the highway, later on, you collect the toll from the public for 10 years. I will not interfere. You construct the highway, you maintain the highway for 10 years. I give you a license to collect the toll from the public. Whichever customer or public uses the toll, you collect directly toll collections from them. That is your revenue. This is the arrangement, means what to do. Now, if you check from this company, do they have a contractual right to receive any cash from the government? No. What did they receive from the government? A license. A license to collect toll. So that means this license will be recorded as an intangible asset. Okay. Because they're not getting any money. They got a right, a license to collect. So that license will be recorded as an intangible asset. Sir, at what value should be recorded license? This license should be recorded at fair value. Why? Sir, did this private company pay any money to acquire this intangible asset? No. It came as an exchange. What exchange? Private limited company will build the highway and in return, they will get this intangible asset. That means this is an exchange. We already studied exchange scenario, right? Whenever there is an exchange, right? As a thumb rule, you have to record it at fair value. So intangible asset will be recorded at fair value. And this intangible asset will be amortized. Here, you have a right to collect the toll for how many years? 10 years. That means this intangible asset will be amortized in my example for 10 years. Okay. And later on, the private company will go on collecting toll from the public. The toll collected becomes your revenue. That is the aspect. Okay. So here, if you have incurred borrowing cost, what will happen? Here, if you have incurred borrowing cost, you already have an intangible asset. Yes. So if during the construction phase, you're constructing highway means construction also will take some time. During the construction phase, whatever borrowing cost you've incurred, you can capitalize to the cost of intangible assets. Once the construction phase is over, once the highway is ready to use, then borrowing cost or capitalization stops. Henceforth, if you have incurred any borrowing cost, that will go up to P&L. In the previous case, since you didn't have an asset, you transferred the entire amount to P&L. Here, since you have an intangible asset, you shall capitalize to the cost of intangible asset only during the construction phase. Other things, after construction phase, you'll transfer this off to P&L account. That's the drama around service concession agreements. Okay. All right. Then another example is simple things. Two things. If two companies, if they're in a similar line of business, if they're in the same line or similar line of business, if they are exchanging goods or service, then it is not revenue. If two companies, if they're in the same line of business and if they're exchanging some goods or service, it is not revenue. Like an example, let's say A Limited is there in Bengaluru. We have another competitor, B Limited, who's in Bombay. Both of them deal with the same goods. Sir, A Limited has a warehouse in Mumbai. B Limited has a warehouse in Bengaluru. Their head office, A Limited ka factory is there in Bengaluru and A Limited ka warehouse is there in Bombay. B Limited ka main office, head office is there, factory is in Mumbai. They have a warehouse in Bengaluru. So now warehouse of the respective company needs some goods. Now A thought if they send the goods, no sir, A ka factory is in Bengaluru, but their warehouse in Bombay. So if they have to send the goods to warehouse means they have to incur transportation cost. because it has to move from Bengaluru to Bombay. Similarly, B Limited, if they have to send their goods to warehouse, means from Bombay they have to send it to Bengaluru, again they will incur transportation cost. So hence A and B Limited agreed. A told 1,000 quantities of product I will send it to Bika warehouse. A and B have agreed that A will deliver 1,000 units of the product to Bika warehouse and B will deliver 1,000 units of product to Eka warehouse. This is what they've done. Okay. Both are in similar line of business. So this is not a revenue because both are in the same line of business and they're exchanging goods and service. So this is not a revenue for both the companies. That is the first point. Okay. Then one of the condition for contract was, we said ARPCC. Last C was consideration collection should be probable. If you have sold the goods, the seller should have a reasonable assurance that we will collect the money, right? So this point is around that. Sir, if the collection of contract consideration is uncertain, we have sold the goods, but we feel we may not collect the money, then what to do? And part consideration is already received, then what do we need to do? Sir, let's say 80% of the money we have received. I'm just giving a hypothetical example. Okay, let's say we have sold the goods worth 10 lakh rupees. 80% of the goods we have already received. 80% of the money we have already received, which is 8 lakh. 20% of the money we have not received, or maybe let's take a bigger example because you're using word significant. Okay, let's say 95% of the money we have already collected. That is 9.5 lakh. 5% of the amount, which is what? 50,000 not yet collected. And we feel this 50,000 we may not collect it. There is some uncertainty in collecting this 50,000. So in this case, what to do? There's a part consideration because full consideration is not received. In this case, no sir, this part consideration what you have received, 9,50,000, you can recognize as revenue. Okay, that's what I'm saying. Part consideration is received, then it is accounted as a revenue only if one of the two conditions is satisfied. One, entity has no remaining obligation. Entity has performed this obligation in full. Whatever promise they had to deliver, they've already delivered. And the substantial consideration is received. Whatever consideration you have received, no, has to be substantial consideration. What is substantial? They're not defined. Could be 50, 60%, whatever it is. And non-refundable. Whatever consideration you have received is non-refundable. One condition should be satisfied, where entity has performed their performance obligation in full, and whatever consideration you have received is a substantial consideration, and that consideration is non-refundable. Either this or the contract is terminated. The contract got terminated, and whatever consideration you have received is non-refundable. Okay, the contract got cancelled midway, whenever it is, and whatever consideration you have received is non-refundable. In that case, whatever consideration you have received, you can book it as revenue. Okay. So I think with this, all the concepts we have covered. So I'll just quickly run over. I think 1 or 2 questions is still pending. That's all. I'll just quickly check. Hang on. Okay. Okay, let's go over question number 12. Okay, what is this question? This is about discount voucher problem. Normally, when you go for shopping and all, they'll give you a discount coupon. No? Coupon 500 rupees, coupon 1000 coupon and all. So if you receive coupon, how to do the accounting? This particular problem. Okay. An entity enters into a contract to sell product A for 1000 rupees. As part of the contract, entity gives the customer 40% discount voucher for any future purchase up to 1000 rupees in the next 30 days. Some discount voucher coupon you have received. Okay. Entity intends to offer 10% discount on all sales during the next 30 days as part of the seasonal promotion. Okay. To everybody, we're giving 10% discount. But to this customer, we gave 40% discount. Keep that in mind. The 10% discount cannot be utilized in addition to 40% discount. Okay. So they say that this customer will not get 40 extra, 10 extra. This 10 is included in this 40 is what they're trying to say. The entity believes that 80% of the likelihood that a customer can redeem the voucher on an average and he will purchase 50% of the additional products. So this discount voucher can be redeemed only against future purchase. And in future, my company feels 500 rupees worth of goods he will buy, and there is an 80% chance that he will buy. Okay. How many performance obligations are there over here? Okay. So one performance obligation is goods. One performance obligation is obviously goods. Here, there is another performance obligation called discount voucher. This discount voucher is also a separate performance obligation. You can treat discount voucher as a separate performance obligation provided it gives you material right. Provided it gives material right to the customer. What is that material right? Meaning, you can say the discount voucher gives material right only if customer gets this right and nobody. Check over here. Since customer purchased this product A, he got a discount coupon of how much? 40%. Every customer is getting 40% discount voucher? No, only this customer is getting. But hang on, some seasonal promotion is going on. Then every customer is getting, any which way, getting 10% discount. And this customer got 40% discount. That means what? How much extra this customer got? 30%. That means that 30% represents material right. Okay, so if customer is getting some extra benefit, that extra benefit only we calling it as material rate. So if customer is getting any extra benefit, then we say discount voucher is giving material rate. And if discount voucher is giving material rate, then it becomes a separate performance obligation. Whatever I'm said, I've just called out over here. Quickly, I'm discussing with you. Okay, so if discount voucher gives a material right, then it becomes a separate performance obligation. And I don't have to tell you, if it is a separate performance obligation, what you have to do, sir? Transaction price has to be allocated among the product. What is the product? First product name? Product A. So transaction price has to be allocated to product A as well as this discount voucher. How much is the transaction price? 1000. So this 1000 has to be allocated to product A and a discount voucher. In what ratio? In their standalone selling price ratio. Okay, sir, what is the standalone selling price of product A? You normally sell this product A for how much? 1000. So 1000 only becomes your standalone selling price for A. Sir, what is the standalone selling price of discount voucher? That you need to calculate. How? Sir, don't take 40% because any which way everybody is getting 10%. Correct? So how material right means how much is the extra? How much extra this customer got? 30%. Okay. This will be utilized what? In future when he purchases the goods. And in future may we say he'll purchase goods worth 500. So into 500 you do. Entire 500 he will buy. Yeah? No. It is expected that it is only 80% chance that he will buy 500. That's what they say. There is an 80% likelihood that he will buy the goods worth 500. That means what, sir? There's only 400, 500, 80%. So this Tika multiplication will give you standalone selling price ka discount voucher, which is correct. 400 ka 30%, 120. So standalone selling price of the goods is this much. So only material right ka discount percentage you need to take. Since every customer was getting 10%, this customer got 40%. Eliminate that 10%. So how much extra this customer alone got? 30%. That way. Okay, and this will be utilized only against future purchase. In future, it is expected that he will buy 500, but there is only 80% chance that he will buy 500. So multiply 80%. So this 1000 has to be allocated among both this. So how much will you allocate against product A? 1000 into this 1000 has to be allocated. What is the ratio of this now? The ratio of this is 1000 is to 120. So this 1000 transaction price has to be allocated in this ratio. So how much it will be? 1000 divided by 1120 into 1000. So against product A, I think I made a mistake. 1000 into 1000 divided by 1120, that gives you 893. I'm rounding it off. That means against discount voucher, you'll allocate how much? 1000 minus 893 I'll do. We'll get 107. So 107 will be allocated again discount voucher. Since this product A is already delivered, you can recognize revenue immediately or recognize revenue when product A is delivered. Revenue recognized when a product is delivered. If it is already delivered, you can recognize revenue immediately. If you are planning, I think it is already delivered, so you can recognize revenue immediately. What about this discount voucher of 107? You can recognize the revenue only when customer recognize revenue. This discount voucher will be utilized only when the customer purchases in future, right? So recognize revenue when customer buys the goods in future. Buys the goods in future, whatever that is, or the discount voucher ka time gets lapsed. Time lapsed. Discount voucher will also have a time. I think here we have a time limit of 30 days. So if customer, let's say, buys the goods, next he buys the goods within 20 days, then on the 20th day only you can recognize discount voucher as an income, as a revenue you can recognize. Suppose the customer does not buy at all, then time will automatically get lapsed at the end of 30th day. On the 30th day, discount voucher you can book it as a revenue. Till then you cannot book. Okay, this one discount voucher wala problem. Okay. All right. Next, anything is there? Just give me a minute. I think we have covered substantially all the problems that I wanted to. Okay, maybe this one 158 will quickly cover. Entity 1, last problem. I think yes. One last problem. That's all. Okay. Okay. Entity 1 sells a piece of machinery to the customer for 2 million, payable in 90 days. Entity 1 is aware at a contract inception that entity 1 is aware at the contract inception that the customer might not pay full contract price. Entity estimates that the customer will pay at least 1.75 million, which is sufficient to cover the entity's cost. Okay, contract says the price is 2 million, but entity feels we'll only recover 1.7 million. That means that 25 lakhs is what's a variable consideration. Are you sure that you'll receive it? No. That means don't add it. So the transaction price here will be what? 1.75 million itself. Rest everything is story. Okay, you can go through that. Okay. So the transaction price in the first case will be 1.75 million. Second case, entity J enters into a 1-year contract with a customer to deliver water treatment chemicals. The contract stipulates that the price per container will be adjusted retrospectively or retroactively once the customer reaches a certain volume. So you will charge the price based on the volume he purchases. If he buys more volume, then we will charge lesser. From the beginning, all the product or revenue will adjust from the beginning is what they're saying. So if he buys 1 to 10 lakh containers, the price will be 100. If he buys anywhere between 10 lakh 1 to 30 lakh containers, for all the containers, we'll charge 90. More than 30 lakh containers if he buys, for all the containers, we'll only charge 85. Volume is determined based on sales. There is no minimum purchase. Entity J estimates that the total sales volume will be 2.8 million containers. So a company feels we will sell about 2.8 million containers. 2.8 will fall in this category. That means the price is 90. Transaction price is 90. Entity sells 7 lakh containers to the customers during the first quarter for a contract price of 100. Since the customer purchased only 7 lakh is in first category. So we have charged 7 lakh rupees from the customer. So what should we do? What should be with the transaction price? Boss, though we have charged 100, we can't book it as revenue because entity feels that the customer will buy somewhere about 2.8 million containers. So the transaction price should be, for each container should be taken as 90. But how much money you recovered from the customer? 100. So that means the journal entry you will pass is bank account debit. How many containers? 7 lakh containers. How much money you recovered? 100. So this is 700 lakh. Can you book it as a revenue? Yes, you can book revenue on 7 lakh containers, but you will not take 100. You will take the price as 90. So this means will be what? So 7 is 63. So 630 lakh you will recognize it as revenue. Balance you will treat it as advance. That is 7 lakh into 10, which is 70 lakh you will treat it as advance. Okay. Later when next time when the customer purchases, this advance will be adjusted or it will be booked as a revenue. Okay. For now, you will adopt the transaction price is only 90, and more and above that, whatever you have received, you will have to park it in advance. This is the treatment for this particular scenario. Okay, third scenario. Entity K sells electric razors to the retailers for CLR. The typo should be INR 50 per unit. A rebate coupon is included inside the electric razor package that can be redeemed by the customer at 10 rupees per unit. Some coupon is given, cashback. Okay. Does cashback transfer any distinct goods or service? No. That means if it is not a distinct goods or service means there's only one performance obligation, that is to transfer razor. Okay. That means what's the transaction price is what? Not 50. He'll redeem for 10. No, but hang on. Entity K estimates that 20 to 25% of eligible razor rebates will be redeemed, and based on its experience with the similar programs and rebate consumption available in the market for similar programs. Entity K concludes that the transaction price should incorporate an assumption of 25% rebate assumption. So the transaction price, sir, you should not include 50. Company feels, how much rebate are you giving? You're giving a rebate of 10. That means you will not recover ultimately 50 from the customer, only 40. Because you collect 10 rupees, 50 rupees from the customer, and 10 you will give it as a rebate. But entire 10 you are giving. No, company feels only 25% of the rebates will be redeemed. What is the rebate cost? 10 per unit. Only 25% will be redeemed. That means the transaction price will be 50 minus 2.5, which will be 47.5 per unit. That is what is the answer. That's what they've given. They've asked transaction price, which is 47.5 per unit, per razor. Okay. Manufacturer enters into a contract to sell the goods to a retailer for 1,000 rupees. The manufacturer also offers the price protection whereby it will reimburse the retailer for any difference between sale price and the lowest price offered to any customer during the 6 months. So we've already sold the customer to 1,000 and we say in the next 6 months if the price falls, we will reimburse you. That's the price protection scheme we have given. This clause is consistent with other price protection clauses offered in the past, and manufacturer believes that it has experience which is predictive in this contract. Okay. Management expects that. That means we are not new to this contract. We have done such contracts before and we have expertise in this regard. Management expects that it will offer a price decrease of 5% during the price protection period. So that means though we have sold it for 1,000 rupees, 5% we may have to refund it back to the customer because we feel price will get reduced in future. That means the transaction price will be 950 in this particular case. So that's what they've told. They've given the answer in all dramas over here and all. Okay. So that's all is the solution for these sort of questions, people. Yes. So with this particular topic also we have fully completed. Thank you so much for your patience. We'll catch up tomorrow. Maybe we'll start the class a little early tomorrow. Around 10 or 10:15 we'll try to start. Okay. Thank you so much. Bye-bye.